Good morning, everybody. I want to welcome you to today's event. Where does the market go from here? It's Saturday, August 27th. You got John Hopkins. I'm going to be very brief so we can get Tom Bowley started. He's got an awful lot to cover. A couple of housekeeping things. Number one, first, I want to welcome anybody new to EarningsBeats. If you haven't been to one of our events, I think you've picked a really good one. Of course, I want to welcome our seasoned veterans as well. You know, our company has been around since 2004. And unbelievably, we've got members who've been with us since we first started. So we give them a special thanks for sticking with us all these years. Like all of our events, this event will be recorded. If for some reason you're unable to stick around for the entire event, no problem at all. You'll be able to watch at your leisure. I want to really reach out and a big thank you to Aaron Weber and Chris Hopkins for all the work they've done behind the scenes. This is a heavily attended event, and I think there's a really good reason for that. The really good reason is our chief market strategist, Tom Bowley, has really been on top of the market for a long time now. And I think you're going to just get a lot of education today, and couldn't be more timely, you know, considering yesterday's sell-off and a lot of people wondering, you know, do we have a long-term problem here? Tom's going to get into all of that. Now, one thing I want to do, Aaron, I'm going to ask you to pull up our special so we can have this up and then get Tom going. We have a webinar special today. This is as good as it's going to get. Typically, we have a 30-day trial for no cost, but we're going to have a 60-day trial, which includes an additional month bonus that gives you 2 full months to check us out and see if we are a good fit for what you're trying to accomplish. The other thing, too, is if you sign up for an annual membership, you'll get 2 months bonus. So you end up with 14 months, cut your costs, 50% savings. The vast majority of our members are annual members. And the reason that makes a lot of sense is because it covers an entire year, including 4 quarters. We think that that gives you an awful lot of time to make sure that we are a good fit. Anyways, make sure you sign up for this. It's going to be good until Monday, so you should act fast. We have a lot of things going on the next 2 months in terms of webinars, special events, so make sure you get signed up for this, and Tom will remind everybody later that you can sign up as well. Okay, well, like I said, Tom's got a lot to cover, and I want to make sure he's in the house here. Good morning, Tom.
Good morning, John. Welcome, everybody.
Yeah. Well, like I said, you know, the market's been very volatile. Last week didn't disappoint. So I know there's a lot of people on pins and needles wondering if, you know, this is, again, you know, the beginning of something nasty, or, you know, maybe something that we can overcome. So I'm going to go ahead and turn it over to you. I know there's a lot to cover. I'll mention one last thing. Any questions that come in, I'll try to answer during the event. And Tom will leave a few minutes at the end to answer any questions. We're not going to get into individual stock questions at all. This is really a macro level discussion. So anyways, Tom, I'm going to turn it over to you, and looking forward to a great session here.
All right. Thank you, John. Yeah, it's really a pleasure to be here today. Yeah, I know it's a Saturday. I want to thank everybody for coming out on a Saturday morning. I know you got choices to do a lot of different things. We have a choices to do a lot of different things too, but this is actually very much a passion of ours to try to educate folks about the stock market. I think that there's a lot that takes place in the market that doesn't get much publicity. You don't see it on CNBC. We have a very unique way of looking at the market. I think you're going to see that throughout this presentation. And so I'm really looking forward to spending some time here. I am going to do my best to get everything that I want to go over. I'm going to try to get through it in an hour, but I can't make any promises. There's a lot of information here. If for any reason you have to go out, this is being recorded. So don't worry about it. We'll make sure you get a copy of the recording, but I will try to go through this as quickly as I can. I just don't want to leave out important facts. I also know that this is a much different crew than I normally talk to. We have a lot of folks in here that are probably hearing about EarningsBeats, Tom Bowley. Maybe many of you don't know anything about stock charts. So there's a little bit of a learning curve and a little different group here that I'm going to be talking to. So if you are a member, you've been with us for a while, and some of this might seem like a refresher, I apologize in advance, but I want to make sure that I'm reaching out to all of you that are new, again, to me, to EarningsBeats, and to stock charts. Yeah, John mentioned, some of you all might be on pins and needles. Hey, I'm on pins and needles too. There's no guarantees what's going on in the stock market. So anytime you see a day like we had yesterday, it puts you on pins and needles. Hopefully some of the things I go over today will help you make some good, responsible decisions, though, about the market, rather than trying to react to one day here, one day there, or last week's rally, or this afternoon's Fed minutes, or that sort of thing. Why don't we go ahead and pull up the agenda and jump right in here. This is what I plan to cover. I want to go through a very, very brief introduction, because again, many of you don't know me, you don't know my background, you don't know anything about me. I want to go through and just maybe spend 5-6 minutes on that, just so that you have a little bit more information. Hopefully I can prove to you that I have some credibility, because I know that's always something when you see somebody for the first time. But then we're going to jump in. I want you definitely to learn some things about the market today that maybe you never knew before. And I'm going to give you some historical facts that I think are going to blow your mind if you're not familiar with this already. Then I'm going to jump into the 2022 top at the beginning of the year. I want to talk about some of the things that led me to make that call at the end of the year that I thought we were topping. I want to go into the 2022 bottom. I've got a video on YouTube, literally on June 16th, the day, well, actually, I think the 17th was the actual bottom. And that was actually the day that I sent out a daily market report to our members at EarningsBeats on the 17th of June. And I don't think I could have had any more conviction. I don't think I could have been any clearer that I said, I am calling the bottom right here and right now, and I am fully invested. And that was on June 17th, and that was the day the market bottomed. I'm going to lead you up to all those things that made me make that call. So hopefully you'll pull some things out of this where you can look at technicals, you can look at things besides CNBC to try to get your financial information to make better decisions. Some say you can't time the market. I think after this presentation, I think you're going to realize that, hey, you might not be able to time it exactly, but you definitely can time the stock market. But I'll go through all that with you. Then I'm going to go through prior bear markets. I just want to show you what prior bear markets look like. We had an anatomy of a bear market webinar that we did for our members back at the beginning of February, because I could see this coming. I could see the whole thing unfolding, and I wanted our members to know what these bear markets look like, because patience, I said at the beginning of the year, patience was going to be critical to get through the first half of 2022. So we'll take a look at prior bear markets. I definitely want to go over market maker manipulation. There's one spreadsheet that I'm going to have to download. So probably right before we start that segment, I'll probably have to take maybe a 1-minute break just to get things set up for you. And maybe that'll be a great time for everybody to take a break anyway and relax. And then we'll, then looking ahead. So in looking ahead, I'm going to tell you where I think the market's going and why I think the market's going there. And hopefully throughout this entire presentation, you'll get a pretty good feel for what the way I look at the market, what EarningsBeats has to offer and how we approach everything, which I think is going to be a really fresh approach for many of you who are very frustrated with the market action and the ups and the downs and not seeming to feel like you have an advantage against the market. I think we have a big advantage against the overall market. All right, so let's jump into the introduction. I want to talk a little bit, just give you a little bit of background. While I do that, I'll at least pull up the screen here and show you, the S&P 500, so you can at least take a look at that. We'll talk about some of these annotations in just a minute. First thing, you need to know is I'm Chief Market Strategist at EarningsBeats.com. I've been in this role since 2004, since we started the company. I was a former practicing CPA. I was a principal in one of the largest CPA firms in the Washington, D.C. metropolitan area. I audited banks, manufacturers, retailers, wholesalers, law firms, nonprofits. I was the firm's accounting and auditing chairman. So I was the go-to person on all things related to accounting and auditing. I've got a tremendous background on the accounting and on the fundamental side of this business, which I think is one thing that makes me a little bit unique when you start listening to technical analysts, because many of them don't have that fundamental background. I think that fundamental background actually really sets me apart, along with a lot of the historical work I do. And that really stems from just the desire to dig into the market and analyze data and figure out what's going on. So I have both the fundamental background and the technical passion. And I think that, again, is one of those things that sets our business apart. As John mentioned, we started this business in 2004. It was primarily to be an education service. I think it's evolved over the years to what I like to call a research, guidance, and education platform. So we get a lot of members who will say, wow, Tom, thank you so much for this trade. I made a lot of money. And while those things, I like to hear those things, that bothers me a little bit, because if somebody says, well, I lost money on this trade, I don't want them running out the door, because we're not going to be perfect. Nobody's going to be perfect. We're certainly not going to be perfect. We're going to make bad calls from time to time. But the one thing that we're going to do is we're going to try to learn from everything we do. I try to learn in the market every single day. So we're going to constantly be providing education to all of our members. So I hope that most of our members see the value in what we do in terms of education, along with the research and guidance we provide, and along with individual stock trades from time to time. But I'm really interested in the educational side. I think that, there's a lot to learn about the market, and that's really one of my passions, and the passion of everyone that works at EarningsBeats. I did leave EarningsBeats for 4 years, from 2015 to 2019, and I joined Stock Charts as a senior technical analyst. Chip Anderson, president of Stock Charts, talked to me. He wanted a morning blog to be written every single morning that the stock market was open. I was an East Coast guy working with Stock Charts. So, anybody on the West Coast, they have to get up and start writing about 4 o'clock in the morning. On the East Coast, I can get up, have a normal schedule, and still publish a blog article before the market opened. So I said I'd do it. And for 4.5 years, I posted articles every day, and I tried to post them right around 9 a.m. Eastern. I'm very punctual. I try to get things done at a certain time so that people can rely on it. And that's what I did at Stock Charts for 4 years. While I was there, Stock Charts envisioned Stock Charts TV, which on this chart here, you can see Stock Charts TV link. They started that probably 3 years ago, and they asked that I be the anchor on their very first show, the Market Watchers Live show, which was a 90-minute show every weekday from noon to 1:30. And I co-hosted that with Aaron Swinlin, who is with Decision Point. So I did that for 4.5 years. In September 2019, I made the decision to return back to EarningsBeats as its chief market strategist for a couple of reasons. Number one, after getting a big following at Stock Charts, folks that were following my blog articles and so forth, I just envisioned a service where I could put all of my expertise in terms of my fundamental side. We do a lot of fundamental chart lists over at Stock Charts. We analyze a lot of quarterly earnings, thousands each quarter, and let our members know which are the best fundamentally sound companies to consider investing in. That's one of the things that we do in our research. So it gave us the opportunity to set up a service that I thought was much needed in the investment community. And then the second reason was a little bit more of a personal reason, but my daughter, Erin Weber, who John alluded to earlier, she went to school, college for accounting, got out of school, became a CPA, and she was not so enamored with the CPA life. And so I said, hey, I'm coming back to EarningsBeats. I want you to come work for us. She started out part-time, has been absolutely gangbusters. Those of you who have worked with Erin, know how prompt she is, how professional she is, and how smart she is. And so it was an opportunity for me to get back together with my daughter, work together, which is really kind of a dream. I think most parents would love to work with their kids and teach them about the stock market and so forth. So this was just an opportunity that the timing just worked out. So in 2019, we all came together, we started working this business, and our business has been doing great ever since. And so really that brings us to where we are right now. So that just gives you a little bit of background. I do a ton of research work and a lot of free work over at Stock Charts. I do YouTube videos. You can find me. You can probably just go out on Google and search my name and EarningsBeats, or my name and Stock Charts, and you'll probably find lots of things, hopefully all good. But anyway, that's basically, where, everything sits right now. So hopefully in 7 minutes, I've been able to bring you up to speed a little bit on where, where things have evolved, and it'll give you a little bit of history of our company. So let's jump in now. I want to show you, let's see if I can bring this up. I'm going to start off with historical facts. So what I've done is just shown you an S&P 500 going back the last 75 years. That's all this is on this chart. But up here at the top, I typed in some historical facts. So you can come back and review this. You don't have to take notes. You can just listen in, and you can come back and review the recording later if you want to get this information. But I think this is phenomenal information. I have a spreadsheet on the S&P 500 that goes back to January 1st, 1950, every single day's action. I have a spreadsheet on the NASDAQ that goes back to, I guess, February of 1971. That's when the NASDAQ was born, tracking all the data. Everything you see here on this page is just historical facts relating to the S&P, but I can promise you most of these key data points that I'm going to go over with you are just as strong on the NASDAQ, if not stronger in some instances. First thing to realize is that the average annual return since 1950 on the S&P 500 is roughly 9%. So if you're just in for the long term, I mean, that's a pretty good return over a long period of time. So that's probably not giving you anything you may not already know, but maybe this is one that you probably don't know. Calendar month breakdown. Let me give you a little insight into this calendar month breakdown and why I did this to begin with. When I was in public accounting and I went out and I audited companies, I noticed that payrolls fell mostly end of the month or middle of the month or both. A lot of times companies were reporting, 31st and the 15th, 31st and the 16th, 1st and the 15th, 1st and the 16th, something like that. So when I started putting this spreadsheet together, that was the first thing I wanted to look at, was to see, is there any advantage in the stock market based on money flows? Because anybody who's putting money into their 401k at all these firms that I'm auditing, and of course, firms all across the country and across the world, anybody that's got a 401k plan, they take that money, and however employees want to invest it, they send their money to Vanguard or Fidelity or whoever with the instructions from each employee of, this is how we want to invest our money. When Vanguard or Fidelity or whoever gets the money, they don't sit back and say, well, the market's a little bit overbought, I'm going to hold off, I'm not going to put the money in yet. They can't do that. They have a fiduciary responsibility. When they get the money, whatever the instructions are, they invest. So if the money comes in on the 1st or the 2nd of the month, they take that money and they invest. If it comes in the middle of the month, 15th, 16th, they take that money and they invest. So when you're looking at this calendar month breakdown, first thing I wondered was, how does the market trade right around the end of the month or the beginning of the month with all this money coming in? Does that have an impact? Well, when I went through, I broke down the calendar month into 4 time frames. The 26th of a calendar month through the 6th of the next calendar month. This is all calendar months. It's January, it's February, it's March, all the way through to December. When I did that, the annualized return for the 26th of the 6th was 21.41%. That's more than double that 9% up there. That's pretty interesting, don't you think? From the 7th to the 10th, only there's a actual the annualized return for those 4 days of the month is minus 5%. That's 14 percentage points below the average. The 11th to the 18th, up 12.64%. And the 19th to the 25th, minus 7.79%. Think that might help in your trading? It helps in mine, I can tell you that. This in parenthesis, I put the number of days that have ended higher for each of these periods. 26th to the 6th, 55.76% of the days we've moved higher. 7th to the 10th, 51.11. The 11th to the 18th, 54.61. And the 19th to the 25th, 49.75. All days combined, it's 53.3. So you can see that there is a statistical advantage over a very, very long period of time. This is a statistically relevant. This is a representative sample. There's no doubt about it. I mean, we got a lot of days in here. The 26th to the 6th, and you might say, well, if the money comes in on the 1st, why would the 26th to the 31st be good? What do you think? Wall Street doesn't know that money's coming in on the 1st or the 2nd? Do you think they're going to wait for everybody's money to come in and buy stocks and then they're going to jump in? Of course not. So they do what I consider to be legalized front running. They're buying stocks before the money comes in. That's why this entire period tends to be bullish. 7th to the 10th, I think, is just profit-taking period in the market. Market makers trade just like you and I. And so market makers who are there to provide liquidity also trade on their own behalf. Well, if they've made a lot of money through this period, they were buying before we were buying. So if they've got profits and they start taking profits, they're going to drive the prices down through that period. And then guess what? It's rinse and repeat to a slightly lesser degree. The 11th to the 18th, the 11th to the 15th, it's market makers, it's portfolio managers. They're buying heading into that new money coming in that you and I are sending in. That's why we get this big pop from the 11th to the 18th. 19th to the 25th, not so much. Why? Well, you got profit taking number one. And then also, if we're moving up to the end of the 18th, historically, when do monthly options expire? The 3rd Friday of the month, which has to fall between the 15th and the 21st. So there's incentive for market makers to bring prices back down. And we do this every month in our Max Payne webinars. We do it the Tuesday before the 3rd Friday of every month because of that right there. The 19th to the 25th historically goes down. The reason it goes down is that you have a lot of folks buying into the 18th, which means there are going to be a lot of in the money calls that will be expiring. How do we get rid of that in the money call premium? Market makers use their capital to drive prices lower and basically to take your option profits right out of your account. You're just left holding the bag. Don't think it happens? How about looking at last week? A week ago Monday, we talked to our members and said, this is a very, very risky period to stick with long positions that we started back in mid-June because there was so much in the money call premium. And by the end of the week, we started the big selling. We had a big down day on the Monday following, right in the midst. It was the 19th and the 22nd where we saw the big sell-off. Friday the 19th, Monday the 22nd. You got to know this information. Best days of the month. This won't shock you. The 1st of the month, annualized return, 45% since 1950. The number of up days goes to almost 62% from the average 53 during the regular, through all the days of the month. Very, very bullish day on the 1st. The 2nd, annualized return, 41%, 60% up days. Again, money is rotating. Money is coming into the market. The 16th ties right with those payrolls. That's the 3rd best day of the month. I'm not making this up. This is fact. The 5th of the month is the 4th best, and then the 31st. Why is that so good? You think the market makers, portfolio managers, hedge fund managers don't know that money's coming in on the 1st and 2nd? They're buying right ahead of time. There's your 5 best days of the calendar month, and they're all related to the money flows. How about the worst days? 19th, down 33.84% annualized return since 1950. 47.1% up days. That means you actually have more down days on the 19th than we've had up. The 9th, minus 18%. That's during that profit taking period right there. And then the 22nd. Remember, I just told you the 19th and the 22nd were the worst. You know, we're 2 days that we just got hit here in August. There they are, 2 of the worst 3 days of all months dating back to 1950. And I hadn't even updated it for the last week. I mean, it wouldn't make that much of a difference because there's so much data. But again, I'm not making this up. This is historical fact. You think this doesn't impact your trading skills to know this information, to know when there's more risk in the market, to know when you get a green light, when you got blue skies ahead? This is another major signal. I'm not going to say that every month you want to buy on the 30th and sell on the 2nd. Probably has a pretty good track record over the years, but I'm sure the first time you do that, first couple times, probably not going to work because again, it's not 100%. It's just that the odds are much better. Okay. So the strongest time of the year, last thing I want to talk about here, strongest time of the year, October 28th through January 18th. So we are a couple months away from the strongest period of the year where we have annualized returns during this period of 20.6%. That is more than double what we just have throughout the year. Very strong period. This period has ended higher than it began 62 of the last 71 years since 1950, including 36 of the last 39. So bears, you better dig your heels in over these next 2 months, because when we get to October 28th, you're going to have your work cut out for you based on the odds in the stock market. Fourth quarter, and it makes sense to me because if a company, you know, you get companies that have bad the first quarter and they're like, well, we had a bad first quarter, but we think things are going to pick up in the second quarter. You have a bad second quarter and you say, well, yeah, the first half of the year wasn't that bad. Second half of the year, though, we see some good things. So everybody's always got excuses. I think September is the month of dirty laundry. If a company still hasn't done anything for the year by September, I think they basically just throw everything in and say, you know what? We had a bad quarter. We're taking these write-offs, blah, blah, blah. And then all of a sudden the fourth quarter starts to look better and the market performs better. That's just my theory. One of my theories. Weakest time of the year. I know everybody says go away in May. Baloney. It's not that May and June are great months, but they're not bad months. Now, when you get into May and June, of course, the best times of those 2 months are when? From the 26th to the 6th. So yeah, the middle parts of May and June tend to be down periods. But to just make a blanket statement, go away in May, is one of the worst pieces of advice that is routinely spread around the internet. I always say it's time to fly in mid-July because I got the data to back that one up. July 18th through September 27th. Annualized return since 1950 is minus 1.3%, which is 10 percentage points below the average. But it's ended lower 31 of the last 71 years. Not 62 out of 71 years, 31 out of 71. This is by no means a slam dunk, but the odds are a little greater that if we're going to have a rough patch, normally this is when we're going to have it. Now, this year, we've actually done pretty well since July 18th. I mean, we came off the bottom in June. Now we're, kind of pulling back. We had a bad day on Friday, and we'll see what happens over the next, next week and over the next few weeks. I'll be honest, and I'll talk about this in a little bit, that this is the Bears' opportunity right now. It doesn't get any better than this. Coming off the heels of what we saw on Friday, Here is your opportunity on a gold plate. Let's see what the bears can do with it, because we broke down below some short-term price support, moving averages. Again, I'll talk about all that in a little bit. But July 18th to the 27th, since we bottomed in 2009, we've only gone down 4 of the last 13 years during this period. So again, this is not a slam dunk, but based on all my research, this is the weakest time of the year historically. So don't go away in May. You want to maybe, fly in mid-July. That's going to be much, much better. All right. That's what I had for the historical data, I believe. Oh, so I talked about max pain. I want to show you a chart. You want to know how you can use this historical data in your trading? Well, again, the Tuesday before the third Friday, we have a special webinar with our members to talk about max pain and what the options are doing and whether or not we need to be careful and which stocks we need to be careful with. Now, Aaron put together a spreadsheet that covered the max pain for every stock in our portfolios. We keep portfolios of 10 equal weighted stocks. So she looked at all of those. She looked at the entire Dow Jones 30 and the NASDAQ 100 and gave that in spreadsheet form basically to all of our members at EarningsBeats, showing them where the price was a week before options expired and where we might see those stocks move toward directional clues heading into option expiration week. I can only tell you that the top 25 on that list in terms of dollar value all went down the week of options expiration. Every single one of them. 25 for 25. I gave members at the webinar one stock that Aaron didn't cover, and I'll show it to you. It was Etsy. Let me explain about Etsy. Here was Tuesday, August 16th close. 3 days before options expired. 120.86 is where it was sitting. That's where it closed. And I told members max pain was $100.76. A potential decline of $20. Now, when we do this, we look at this as a directional clue. So in other words, if you wanted to buy Etsy, my response would have been, why in the heck would you want to buy now when market makers have incentive to drive the price lower into options expiration? By the time we got through the Monday after options expired, we had gone down to about $102 from 120 in 4 trading days. Now, if you were thinking about buying Etsy at that time, I mean, it looked pretty good on the chart. Why wouldn't you buy it? Trending higher? I'll tell you why you wouldn't buy it. Because market makers had $23 million worth of reasons to bring that stock down. That's how much in the money call premium, net in the money call premium was on just one stock on Tuesday. So you can imagine we start looking at all those stocks, ETFs, index options, and everything else, how much money was at stake. One stock, and look what happened. That's the importance of knowing some of these things that we talk about in the market. All right, let's move on to the 2022 top. So the first thing I want to do is just go back and show you that S&P 500 chart that I had up here a minute ago. So 2022, right here, December 31st, after the market closed, here was the article I wrote in one of my blogs. You can see the timestamp on it. December 31st, New Year's Eve at 7:44 p.m. This proves that I have no life and that I am way passionate about the stock market, because while everybody else is out, with their New Year's Eve parties, I'm sitting here writing an article about what I'm seeing in the stock market for the next year. And so you probably don't want to talk to me at a New Year's Eve party when I finally show up, because this is what I'm going to talk about. Everybody back then was bullish. Market was going up. What's to worry about? Well, on December 31st, I told everybody what there was to worry about. So obviously inflation was a big problem. But a couple of things I didn't like was throughout 2021, we started seeing growth stocks getting hit versus value stocks. That's the small cap growth versus small cap value. But one thing I pointed out that was so important back then, the month of December, when we made the final high right here, you see how we took out those prior highs? This final move up in the month of December was led by consumer staples, real estate, utilities, and healthcare. 4 defensive groups. These 4 groups have no business leading a bull market advance. Why would everybody want to get into defensive stocks when the market's setting new all-time highs? New all-time highs means the market's in good shape. You want to buy those companies that are, really growing earnings rapidly. Consumer discretionary, technology, communication services, industrials, financials. Those are the 5 aggressive groups. Where were those? At the bottom. And the performance wasn't even close. Anybody who looked at this had to be thinking, oh my gosh, what a major red flag. Yet I can promise you one thing, it wasn't discussed on CNBC, because this isn't, number one, how most people even look at the market. I got a lot of this intermarket relationship stuff from John Murphy, who's a renowned author. He was on CNBC for 7 years as their technical guru. He's written books. He's now featured over at Stock Charts. I've met John. He's a great guy. And I got to say, he was one of my inspirations, one of my key inspirations in really digging into the market. When I started reading his books and seeing his work, it just set a fire inside of me to figure out what the heck is going on and why Wall Street has all the advantages and you and me struggle. And I started running into things like this. And I started seeing, wait a minute, this doesn't make any sense. And it wasn't just this, there were a combination of things. And I'm going to talk about all those here as I go through this segment. But this was big. This was really, really big when defensive groups are leading. Normally, defensive groups lead when the market goes down, not when the market goes up. So I wrote about that. I mean, you can go back and read this article if you want, but right here, I said defensive groups frequently lead when the stock market is weak, but rarely do they lead when the stock market is strong. Wall Street is losing confidence in this bull market rally, and so should we. Again, I'm just pointing out what Wall Street's doing. Nobody else is. But to me, that's really important. And so I said on December 31st, I believe this is setting up for a very difficult period ahead. I mean, these next few sentences were really important. How difficult will it be? Well, I plan to discuss that topic at our Market Vision 2022 event on Saturday, January 8th. Free event. Last January, talked about the S&P would finish at 4750, up 1,000 points from the prior close. With COVID, not too many folks were going out on a limb calling for a 30% advance. Yet we closed at 4766, 16 points away from where I had suggested the year before. And this was key. I see an absolutely wild 2022 ahead. It will be very important to protect your capital throughout much of 2022. And I'll discuss how to do that next Saturday. I was talking about it before it started. And so part of this segment is to go and show you some of the things I talked about and some of the things I was seeing that they were red flags waving for me. And so I was waving them for our members. So there's the December 31st article. Now, I also write over it. I still do a lot of articles at Trading Places with Tom Bowley. This is a free blog. And by the way, if you want to, if you go into any of my articles, down at the bottom, after the article, you can put in your email address, hit subscribe. It's free. There's no credit card, anything. And when I publish an article, it'll automatically get sent to you. A lot of people don't realize that's down there, but that's a great way, because otherwise you just have to come over and look for my stuff. And I might post on a Friday one week. It might be a Sunday the next week, a Tuesday. You're not going to know. But if you sign up at the bottom there, anytime I do an article, it'll be sent to you. So this one, Great Divide presents big problems and a wild prediction for Apple. So in this article, I talked about the S&P 500 breaking out. And here was the XLK technology ETF relative to the S&P 500, breaking to a new monthly low. That says the S&P is going up. Wait a minute. Technology is a big leader. What's going on here? How about discretionary stocks, XLY? Another aggressive group. Market's moving up, but again, its relative strength is weakening. Look at communication services. This is home of internet stocks. Look at that going into the end of the year. Horrible. Financials down, industrials down. All these groups all falling apart simultaneously on a relative basis. Wall Street is moving out of them. Do you see it when you look at the S&P 500? No. All right. Apple, I just simply went on to say down here that, it's had a lot of different drops in the 20, 30, 40% area, and that I could see Apple dropping 20 to 30% from where it was at the beginning of the year. I said, I'm taking the other side and believe Apple could see a 20 to 30% slide. Talked about, the drops it had in the trade war. During the pandemic, it fell 35% in 6 weeks. And so I said, it happens to even the best companies. So, I said even just a simple 20% decline would take it down to 140. 30% decline would take it down into the 120s. Ultimately, that's where it went, down to the 120s. So that was another article. That was on January 4th. That was the day the market topped in the afternoon. And I'm writing about how much Apple could drop. Next article that I wrote, this was January 23rd. This was after the first big leg to the downside. And a couple things I'd point out here. I said there are 4 bold predictions. One, perma bears are now going to come out and claim victory. And the next depression, which that's all we've been hearing about, is how bad the market is. Next thing I said is this is a cyclical bear market, not secular. Cyclical is short term. Secular is long term. So just talked about ignoring CNBC, study history. We did a anatomy of a bear market event for our members at EarningsBeats in early February to explain what to expect. This was an article that I did, or not an article, this is a chart that I did for Market Vision 2022 on January 8th. Now, this is as of January 21st, but I went back and took out the data for the first part of January. But this, when I showed it on January 8th, this is how it looked. And this is what I was calling for. A move back down to test this center line, which was roughly 24%. Our low, I think, was 24.72%. And then a recovery in the second half of the year. Basically, I drew the low to the end of June. The low I called was on June 17th. So again, went through, talked about that fact that gold was going to soar. I thought it was going to go to 2,000 in the first quarter. It actually went above 2,000 for a couple of days in March and then came back down. I thought it could go to 2,500. It never did. So it came back down from the 2,000 level. And then the final one, and this was a biggie. Sentiment will be reset. I'll show you some sentiment charts in just a minute. Actually, I'll show you one here in just a second. But sentiment was huge because everyone was so bullish at the end of 2021. If you were going to buy, you've already bought. I mean, the market doesn't get as bullish from a sentiment perspective as it was at that point. Let me pull up a chart for you and show you what I'm talking about here. So here was the chart that I shared at Market Vision back in January. So that arrow I showed right there was on January 8th. And all this is a 253-day moving average. 253 days, trading days, is the equivalent of 1 year. So it takes a while to really get this freight liner moving. I'm thinking about the big ships. This doesn't move very fast, but when it gets going in one direction or the other, it's really important. So in this relationship, This is the equity only put call ratio. So puts are your numerator, calls are your denominator. Puts are bearish. People are bearish when they're buying puts. People are bullish when they're buying calls. So as this ratio increases, it means the numerator puts are getting, bought more often. And that means that folks are getting very bearish. So as the market grows more and more bearish, what happens? The market struggles. Then when we start coming down, that's when the market tends to do extremely well, because we reach an extreme bearish sentiment and we roll over. There's no more sellers. We come back down, market does great. Then we get to a point, too many buyers. We start to turn back up, market struggles. This down here is just calculating how much the S&P rises or falls during these various cycles. Then 2012, we get too bearish and this starts dropping. We rose 56% in 2 years. Much better than that 9% average. That was 28% average. Then we got too bullish. Sentiment moves back higher. Equity only put call rises over these 2 years, year and a half. Well, basically 2 years, S&P goes nowhere. Then we come back down. S&P goes up 47%. 2019 with the trade war and then the pandemic was really choppy. But I think ultimately we did finally get a good signal. Market turned very, very bullish. And we went down to readings that we had never seen before. These are crazy readings. Now, you might say, well, why didn't you call the bottom when it was here or when it was here or when it was here? Well, number one, it hadn't turned. And number two, everything else came together at the end of 2021. Calling the stock market is a puzzle. It's a big puzzle. You don't just look at one thing. That's throwing your own personal bias into it. If you just look at one thing, if you follow 10 indicators and one of them turns bearish and you're just naturally a bearish person, you're going to point to that one thing and you're going to say, market's going down because this indicator's turned lower. I try to put a story together. So we had a market that was insanely bullish. So you got a lot of retail traders buying calls hand over fist. And why not? The S&P 500 at the end of the year was setting a new all-time high. But what was Wall Street doing? Wall Street was positioning out of the aggressive areas. Not telling anybody, just doing it. You only know if you study the charts. They're telling you on the charts what's going on. They're not telling you at CNBC. So here was the start of this move to the upside. What happens when we turn higher and we rise? The market struggles. Doesn't always go down. We did in 2007, 2009. But sometimes it just means the market struggles is weak and just doesn't do anything. Well, here, when we moved up, we actually did roll over. And again, there were other signs that were pointing to a cyclical bear market ahead. And there was the decline through June, mid-June. And then I believe we've started the recovery. Could we be rolling back over? It's possible. We'll talk about that in a little bit. I don't think we are. I don't think we're going back down to the June low. I definitely don't think we're going below it. But I don't think we're going back down. Even if we did go back down from where we are right now in the S&P 500, it would be just around 9 or 10% from where it is right now. I think that's worst case, but again, I'll talk about that in just a bit. So let me show you the next chart. This is a 5-day moving average of the put call ratio. And this was another reason when you're looking at the 5-day moving average, it went down and was sustained in this range between 0.35 and 0.55 almost the entire year and 6 months. I mean, we were at a level with the 5-day moving average where the highest level we got to was about 0.6. And if you look at the last 16 years, I would say the average through all of these years was probably around 0.65. And yet for a year and a half, close to 2 years, we never even got to the average. That's how crazy bullish everyone was. Think about the Reddit folks, Wall Street Bets, and all those meme stock traders. They didn't know what a bear market looked like. And unfortunately, They found out. Never ends well. When you think you're a market genius, it never ends well. Its market is always changing. And you've got to be watching the story in order to change, not after it, but hopefully with it. That's what you want to look for. So anyway, that's, what I would be, focusing on when I look at sentiment, is using that as one of the key indicators, maybe not by itself, but in conjunction with other indicators. Okay. All right. So let's move on to the last thing I want to show you about this top, which was the sustainability ratios that I had. Now, here was the S&P 500 from March to December of 2022. And then we had the XLY, XLP, which is consumer discretionary versus consumer staples. Okay. And then we had consumer discretionary versus consumer staples, which went down. I already talked about that a little earlier. Another ratio I like to follow, NASDAQ versus the S&P, was going up throughout the year, all of a sudden turned down in December. IWF versus IWD, this is large cap growth versus large cap value. Growth stocks were going up into the end of the year. December rolled over right as the market was setting a high. So the final leg went up and the sustainability ratios that I like to follow went down. And then look what happened. Then the S&P followed suit. S&P goes down, and I'm going to talk about the market bottom in just a second, but that'll be the next chart that I look at. But this was another way of looking at it. Same thing, basically. S&P going higher. Here were the charts, December, January, and how we kept going down at each stage. Every time the S&P went to a new low, these ratios went to a new low. See all of that? And then there was the December, that was the December performance by individual sector as the market made its final high. So this is a great place to start the next segment, which is the 2022 bottom. 2022 bottom right here, you can see the consumer stocks did the best. Everybody was talking about a recession. Why would consumer stocks be leading the market during the next move, this last move down? Makes no sense. Why is technology and industrials up here at the top? They weren't here. I can promise you that. And then down at the bottom, we had utilities, real estate, healthcare. These are all the defensive groups. Normally they lead on the way down. All of a sudden they turned. Now we've got everything flipped. And Wall Street, of course, without announcing it on CNBC, they're rotating into aggressive groups. Look at my sustainability ratios going higher. QQQ Spider turning higher. Here the market went to a much, much steeper low right there. I mean, it accelerated to the downside. This ratio didn't. This ratio didn't. This ratio didn't. Here's large cap growth versus large cap value. That didn't. Mid cap growth versus mid cap value. That didn't. Small cap growth versus small cap value. So what's going on here? Stock market is completely changing right before our eyes if we know how to look at it. If we're following the Peter Schiffs of the world or the Jeremy Granthams of the world that are pounding the table about this is the next Great Depression, everybody's freaking out. And I'm going to show you some manipulation on this last move down in just a couple minutes, but let's finish going through the bottom here. So now let's look at the sentiment chart. So let's look at the sentiment chart where we are now. Now, all of a sudden, we've made this big move back to the upside. And I'm looking for it to turn somewhere in the 0.575 to 0.60 range. That's where I think we're going to ultimately top and roll back over. The reason that it hasn't topped yet is because we had such an extended run. The put-call ratio was so bullish for such a long time. Right now, through August, we're only replacing up through August of last year. We still have the fourth quarter to replace. So I do think we're going to eventually start topping here, and it may be happening sooner than I think, but I think we're going to roll back over. And when this starts to roll back over, that's going to be the final explosion, in my opinion, back to the upside, which I think occurs later this year. And I'll explain a little bit about that in a bit. So next up, let's see, I wanted to talk about a couple articles. So the first one was in July. Let me go back here. I'll pull this up. So again, I can go back into my archives. I know this was a July article. Right here. So July 31st, we're heading for new all-time highs. And there was the chart I talked about that I had discussed at Market Vision. This is how it's played out. I mean, almost perfect. But the one thing I wanted to mention here is how cyclical bear markets developed. So I talked about this back in July. These were the declines of all the cyclical bear markets that we've had since 1950. Now, what I want you to really concentrate on here is this column right here, 1 year later. Once a bottom goes in, if you look 1 year later, the average 1 year rally off of a cyclical bear market is 42.6%. That's why it's so important to forecast. When you wait for Jim Cramer or some of these others, I know Jim Cramer just came out the other day and said he's calling the bear market bottom. Oh, well, great, Jim. It was 2 months ago. It's easy to call bottoms after the market rallies for 2 months. You know, go to an all-time high and we'll probably have a bunch of others coming out and saying that that was the bottom. Well, that's great, except it doesn't help you make any money. In the meantime, while you're bearish during all these rallies, the market keeps going up and you're just losing money if you're on the short side. So the importance of calling a bottom is realizing that the best, most bullish moves in the market are missed if you're not in at the bottom or close to it. After the 2020 pandemic in March, we went up 78% the next year. Now, that was the highest of any of them. We went up 58% back in 1982. Just pulling these up here. Then we had some others. The lowest was 30% in 1990. So a year later, we were up 30%. That was the worst of all of the bear markets that I studied. So I just wanted to point out that's the significance. That's the reason why I want to be able to call bottoms and tops. Because if you can't do it, you're going to miss out on some of the biggest runs. I can't tell you how many people have been writing for the last 2 months that we're still in a bear market. And if that's your belief, you're not going to buy into this. The NASDAQ went up 25% from the recent bottom in June to the high that it set 10 days ago. 25%. That was a massive rally. Most of our members, I was getting a lot of feedback that our members were loving life because they did get in. They did follow me at the bottom. Some were very skeptical. Some did a little bit. Some did, 100%. I've had people say, I did it with you. I jumped in. But if, the one thing I'll say that I have is conviction. You may not agree with me, and I may not be right all the time, but I do have conviction. And when I see something, I'm going all in on it. Until I'm proven incorrect. Good friend of mine in this business years ago said, it's okay to be wrong. You just don't want to be wrong for long. And so those are words I try to live by. The other thing I wanted to talk about in terms of blog articles was look at this one. Are you prepared for a major bottom? That was written on Sunday, June 19th. That was after I had sent out to members on June 17th that the bottom was in. I also, if you want to go back and listen to this show on YouTube, I'm calling the bottom in the S&P 500, June 16th, one day before it happened. I mean, again, I have conviction. If I feel it, I'll say it. and I'll give you my reasons. And you know what? It's a stock market. You can agree or disagree. All right. I know we're at the 1 hour mark. I'm trying to go through all this as fast as I can. One last thing on the bottom that I think is worth pointing out, and that is, let's go to this next chart. There was a 60-minute positive divergence right here, where prices kept going lower on the S&P 500. That's June 17th right there. So not only did we have all these long-term signals that were saying it was in, also had a bottom showing up on the hourly chart that happened to just coincide perfectly. Positive divergence. PPO much higher. Prices keep going lower. That's a sign of slowing momentum to the downside. And that marked the bottom. Now, normally I wouldn't look for major bottoms when that forms, but it occurred with everything else where I did call a major bottom, where I did feel like there was a major bottom. So this was just, more icing on the cake. All right, let's move on to prior bear markets. So the only thing I want to do is just show you what prior bear markets look like. I'm going to go through these charts very fast. I'm going to go through from worst bear markets to the least painful bear markets in terms of percentage drops. And some of these, the secular bear markets, and I've identified these first three as secular. I'm going over every bear market we've had since 1950, by the way. But the secular are painful, not only because they go down more, but because they last longer. That's the distinguishing feature between secular and cyclical, which you'll see as I go through here. 2007 to 2009, there are some who are arguing that maybe we're at this stage right now and that we're starting to roll over and this is going to morph into something similar to 2007 to 2009. If that's your way of thinking, go for it. It's not my way of thinking. I disagree with that wholeheartedly. I believe we are in a secular bull market, and I'll show you why when I show you a long-term big picture chart in a little bit, but I don't believe that. Anyway, let's keep going. 2000 to 2002, secular bear market. That's what it looked like. Again, very, very lengthy, and it's a big, big drop. It's just ugly. These things are ugly. 1973, there's your next secular bear market, 73 and 74. I mean, we were up at 120. We dropped down to 60. We lose half the value of the market. The other two I just showed you were more than 50%. 2007 was almost 60% that we lost. So secular bear markets, the history is that we lose 50 to 60% of the value. So on the S&P 500, we were at 4,800. If this is a secular bear market, look for probably somewhere in the 2,400 down to maybe even 2,000 range, all the way back down to the pandemic low. That's what you'll be looking at if it's secular. Again, I don't believe it. I'm just giving you both sides of the argument here. Now, let me show you the cyclical bear markets. There were only 3 secular bear markets since 1950, 3 in 72 years. So if you believe that this is going to be the 4th one, you're really going out on a limb. Doesn't happen very often. Just want to point it out. There's only been 3 of them. So cyclical bear markets, there have been 11. So usually these bear markets tend to be short-term in nature. Here's 1968. There's the top. There's the bottom. 1987. There's the top. There's the bottom. 2020. There's the top. There's the bottom. 1961. There's the top. There's the bottom. 1980. There's the top. There's the bottom. This was kind of a lengthy one. It was at the end of that secular bear market in the 1970s. So it was a little odd. The late 60s are the same thing right before that secular bear market in the 70s. 2022, this is what I believe cyclical bear market was right there to here. I think that's the bottom. 1966, top, there's the bottom. This is the one, well, 66 went drug on a little bit longer than many. 1998, top, bottom. That was a very quick one. 3 months, but we dropped 20%. 1957, there was the top, there was the bottom. And 1990, there was the top, there was the bottom. 2018, there was the top, there was the bottom. So as you go through here, it's just good to understand that it's okay to have cyclical bear markets within a secular bull. That's what all 11 of these cyclical bear markets were. If you throw 2022 in, which is what I'm doing, I believe it was a cyclical bear market. Now, if you look at the subsequent recoveries off these bear markets, some of them, we went back down and had a double bottom. But most of them, we didn't. Most of them, we pull back and have some scary moments. There's 2018. Looks like, oh my gosh, we got up here, double top. We're rolling over. Scary. But what happened after that? We went back up. And I could go back and probably point out a few others where we had scary moves to the downside. You might look back now and say, well, it doesn't look that scary to me. It kept going higher. That's because you had the benefit of knowing what happened afterwards. At the time, if you're looking at this, I guarantee you most everyone was saying we're going back down to the 2019 low. Heck, I might have been saying it. I don't remember what I was saying. But at the time, that would have been a scary move to the downside. And the way you know potentially that we're not going back down there is when we start breaking back above key moving averages and going to new highs. Higher high, higher low. We never went back down after that. That set the uptrend. So yeah, that might have been scary, but it should have been temporarily scary. And so that's one of the key points that you need to be thinking about for 2022. And again, I'll talk about that in just a bit. So that's it for the prior bear markets. Now I want to talk about market manipulation. I'll tell you what we'll do. Aaron, if you're there, could you share the special with everybody?
Hey, Tom.
John?
Yeah, what I'm going to do is I'm going to, while you're setting up for the next session, I'm going to share the poll results and we'll throw the special up as well.
Okay, yeah, and I'll give my take on the poll results when I start that final session.
Sounds good. See you in a few. Okay, so here we go. We got virtually everybody responded. We have a lot of people in this session here.
I don't think you're seeing this yet, John, because I'm still showing. I'm gonna stop sharing the screen. Somebody needs to share that.
Yep, I can see it.
You can see it? Everybody can see it?
I can see it.
Okay, never mind. I'll leave you alone.
Oh, even if you can't see it, I'll just share it right now what the results were.
Okay.
There were 4 questions. The first being, well, the question being, where do you think the market will be at the end of 2022? And there were 4 possible responses. The first, the bear market's not over. We're going back. And you can see that 28% thought that was the direction. The bottom is in, but we're going to be flat. 32%. We're in an uptrend going higher into year end. 35%. That's the top response. And strap in, we're headed back to an all-time high this year. 6%. So based on this analysis, you can see that the majority, plus, are thinking that we've got maybe some more positive action ahead in the market. And I know that Tom will talk about this. We've had a couple of questions from people who saw John Murphy's article about this past weekend about a downtrend and asking if that changes Tom's mind. And I would just tell you that Tom has tremendous respect for John Murphy, but anything that Tom does really is from his own analysis in looking at charts and the deep experience that he has. A lot of people are asking questions about, does Chairman Powell's discussion yesterday in the market getting whacked change Tom's mind? You can have all these, daily things that happen, but I think Tom is really looking more at a macro picture. So these singular events, don't necessarily change anything that he's thinking. He's really looking very focused at all the information that he's sharing today Tom looks at to draw his own conclusions. Anyways, that's the poll results. Now let's go ahead and pull up the special. We've already gotten some really nice results. So Aaron, if you want to pull that up. Let me just say, if you're seeing us for the first time and you like what you see and you'd like to learn more about us, you'll never get a better offer than a 2-month free trial. Right now, we offer a 30-day trial. So we're adding a bonus month that gives you an extra 30 days to check us out, to make sure we're a good fit for you. So if you're even contemplating it, you really have nothing to lose by signing up for a 60-day trial. And we're going to be covering a lot of information, a lot of webinars during that period of time. This is really the time to take advantage of that. And then the other thing is the 2-month bonus. If you sign up for an annual membership, you get 2 months bonus. So you get 14 months for the price of the annual, cut your cost in half. Again, very difficult to beat that as well. So free trial for those of you new to EarningsBeats, and then the annual membership will really save you a lot of money over the course of the year. You get 14 months. Okay, I know Tom I think is ready to get back in. You about ready to go, Tom?
I am.
Let's move ahead.
All right. Let me, yeah, I just had to download something that I wasn't able to download prior to the webinar starting, but I got it now. I'm not going to bore you with this spreadsheet for very long, but I think that this is absolutely fascinating information. It's really important just to show you a little bit about the manipulation that takes place in the market. I actually did a YouTube video on it a couple of weeks ago. And I think if you go to YouTube and you Google Wall Street Thieves, THIEVES, Wall Street Thieves on YouTube, you'll probably see my video pop up. And if you want an entire show that's dedicated to what I'm going to show you right now, that would be where you would go. I don't want to spend that much time on it now. But let me just quickly show you what I did in this spreadsheet. And again, I think this will help you understand the kind of work that we do at EarningsBeats, which is completely outside the box from what everyone else does. I do a ton of research. I am so passionate about the stock market. I can't even begin to tell you. I mean, it's like one of my hobbies. I love this stuff. There are times I'm like a dog on a bone with some of this stuff. And if I've got something to do, and I'm also an avid golfer, and sometimes if I have to choose between the two, I actually will pick the stock market analysis over golf. I know that sounds crazy, but I love this stuff. I love to analyze. It just comes back from my CPA days. And I think we can glean so much information from how the market operates. So let me just explain this spreadsheet to you for a minute. This is the QQQ. It's this is the ETF that tracks the NASDAQ 100. So many of the largest technology and consumer discretionary names. There are other sectors represented as well, but these are really big names. I mean, we're talking Apple, Microsoft, Tesla, all of the big boys that are in here. And so I went back and I tracked the QQQ starting back in November. And the reason I picked November 19th close is that was the highest close on the QQQ. And if you remember, I talked about how there was some manipulation taking place in rotation that took place in December. Remember how all the money went toward the defensive areas and how it didn't go very much toward the aggressive areas? Well, this kind of illustrates that, because here's November 19th on the QQQ, and here was January 4th. Remember, the S&P 500 topped on January 4th. We never went back up and went through this November 19th. I think we got 1 penny, yeah, 1 penny above on the 27th. But when the S&P was setting its final high, the NASDAQ, loaded with many of these aggressive stocks, couldn't get through. Why? Because Wall Street was already starting to unload them, unbeknownst to the rest of us, unless you were looking at the charts and unless you were looking at the 1 month sector performance summary that I showed you earlier. So what I did on this chart is, I've got a belief, and I'm sure many of you as well believe, that the market is manipulated to some degree. I mean, I don't think there's any question. Before I did any analysis, there was no question in my mind that we have a lot of manipulation. We see it around money flows. I showed you that earlier with the historical information. We have it around max pain, the third Friday of every month. I showed that to you in terms of the historical performance. I think we also have manipulation during the day. And so I set out to prove it. So here on the QQQ, I've got a close of 402.20 on November 19th. At the open on November 22nd, which was Monday morning, I put the price in, and then I went through and I showed the price at 10 a.m., 11 a.m., 2 p.m. and the close. And I did that for every single day through Friday's close, Friday, August 26th, yesterday. I've got it all updated right to today. And then over in these columns, I should have just put these titles up here. Basically, this is the change from the close to the open. So you can see which cells are highlighted there. So we went up $1.58 at the open. Here, we went up $2.01 in the first 30 minutes of trading. Then we went down 54 cents in the next hour, went down 4.54 in the next 2 hours or 3 hours. And then the final 2 hours into the close, we went down 3.18. So we did see a little distribution there, and we saw a little accumulation at the beginning and then distribution at the close. But what I did is I broke all of this data down into segments. So here we went from 402 down to 381. So this was a sell-off. And so I totaled each of the days, totaled the opens, totaled the first half hour, totaled the next hour, totaled the next 3 hours, and totaled the last 2 hours of the trading day, and did that for the entire period during this sell-off. Then we rebounded from 381 to 397. I did the same thing. I got the totals for that period for each of these time frames before we started selling off again, 397 to 379. Once again, I got totals. I'm not going to go down. I mean, obviously, that's what I did for the entire year. I did uptrends, I did downtrends, and I got totals. Then what I did is I did this summary. So here was that first period I just showed you, November 22nd to December 3rd. So let's go back up here. Just want to show you 351, 420. Come down here, 351, 420. So all I'm doing is picking up the totals for these periods. All right. And then I color coded them. If we went up green, we went down there in brackets and in red. I think I got all the color coding correct as I went through here. And I did all the periods. Okay. So since November 19th, the QQQ has gone down $94.76. And I got all kinds of audit trails. You'll tell I'm a CPA. So I wanted to make sure 94.76, I did 307.44, which was where we finished yesterday, from 402.20. So there's your test, if you will, or control. We lost 94.76. Each of the periods I totaled out to the right-hand side, and then I totaled those to make sure I've got 94.76 so that each of these individual totals, when I carry them down here, get carried correctly. And when I total these up and come across 94.76. So yes, I'm an accountant, audit geek. I'm a nerd when it comes to these spreadsheets, but I love this stuff. I love to tear in. I was the same way when I was a CPA. I'd go in and audit companies. I love to see what makes companies tick. And in this case, I just love to see what makes the stock market tick. And so I'm digging in, and I want you to look at some things here first before I start breaking down this further. Since November 19th, look at the net gaps. We've gapped down $53.26. We've gone down 94. 53 of it has been gap downs. Then we move into what I like to call amateur hour, which is really this 30 minutes and this 60 minutes, but especially this 30 minutes. So let's just say 30 to 90 minutes. You gap down $53. In the morning, you traded down another $46. That's $100. And then tack on another 38 by 11 a.m. During the entire period since November 19th, the QQQ between the close and 11 a.m. the next morning has dropped $138. But wait a minute, we only went down 94. Well, once we get past 11 o'clock and we get past amateur hour, what happens? Well, for the last, even though we've had this huge bear market since November 19th, from 11 o'clock in the morning to 2 p.m., we've lost a total of $3. And this one is the one that blew my mind. 2 p.m. to the close, we've gained $46.54 during a period where we lost $94. How does that happen? And what makes it even more is the first big drop when we went down, which I think was truly the distribution. We topped at the beginning of January. And I think when a lot of folks, like real folks, were getting out, this is the period. The opening gap, we went down 10 between 10 a.m. or between 9:30 and 11. You can see we had pretty good movement to the downside, a little bit of strength middle of the day, but then look at all of these different periods. The only one, well, there are really two on a percentage basis. The only two that on a percentage basis had really poor performance in the last 2 hours of the trading day were January 4th to the 27th. That's where we saw almost half of the losses in the QQQ came during the last 2 hours. That was truly distribution time. And I'll show this to you much more clearly on a color-coded chart in a minute. I'll help you visualize all this in just a minute. For now, just deal with me and my geekiness in my spreadsheet. So that one was clearly selling. And then when Wall Street was getting out back at the end of November, early December, you can see there was some distribution there. 30% of the selling was actually after 10 o'clock in the morning. Look back then when the market was going up, or excuse me, when the market first started coming down, we were in a bull market at that time. Look what the gaps were doing. An amateur hour. It went up. And look what else. Look what happened later in the day. Everybody else was getting out. Wall Street was getting out. We didn't know any different as retail traders. The meme folks, the Wall Street bets, Reddit, they're treating this like it's an ATM machine. Let's just keep going in on the long side. Then they get the carpet pulled out from under them. Then as you go through the bear market, you're going to see the reversal where we're getting big gap downs, big morning weakness, and then the carpet gets pulled out from under the bears and we rally. So from this chart, I just did a little bit further breakdown. So the periods over here are the same. All the periods are the same. The only difference, here's the opening gap, which was the same as that. The only difference was balance of the day. I just took the 11 a.m. to the close. I just combined these two periods because this is really what I wanted was open, morning period, and then balance of the day. So as I do that, then I've got this. And what I added on this one was eyes for the initial Wall Street reaction. The D's, which in my opinion, all the way down to here was the period of distribution. The M's were the market, what did I do there? Market recovery. Manipulation. I'm sorry. Manipulation. That was at the bottom. When we went down to that bottom, remember I showed you all how money was rotating? Yeah, there was a lot of manipulation taking place according to this as well. And then the last four periods there were the recovery coming off the bottom. So that's how I broke it down into those four areas. I, D, M, and R. Oh, fifth period I added, which was just this last 10 days, because here was the recovery. And then the last 10 days, now it looks like we're going back down again. Right? So I forget what I called that, but maybe I think I just called it pullback. Yeah. Bear's last gasp is what I'm calling it here. But basically, I put a P for pullback. So now I've got this totaled. So when I look at this right here, it's all of these eyes opening gaps combined. Here's the amateur hour. Here's the 10 a.m. to 11 a.m. and there's balance of the day. All right. So I've got it for each of these periods. What I want you to see more than anything, look at the distribution phase. which is January 4th down to May 20th. Distribution phase, opening gap goes down 30. Amateur hour goes down 35. 10 a.m. to 11 a.m. goes down 33. Balance of the day goes down 15. There was no buying or very little buying. That was distribution. No doubt about it. Lots of selling. You don't want to be getting into the market in the face of that. But as we went down to the last low, so here, I think we rallied back 523 to 6.7, and then we went to that final low, 6.8 to 6.17. That's the manipulation period. I want you to look now at opening gaps, down 25, manipulation period, amateur hour, down 9, from 10 a.m. to 11 a.m., another 4.5 down. And I want you to look at the end of the day. Last 5 hours of the day, while the market was setting that last low, it was one of the biggest drops during the entire period. But what was happening at the end of the day? Buying was taking place. Who in the heck was buying when the market's going to a new low? Wall Street's claiming, here, oh my gosh, we're falling apart. The sky's falling. You get all these bears being paraded in, one analyst after another, talking about how far we're going to drop and how bad things are. And retail traders are falling for it. The market gaps lower, and then they chase prices to the downside. And then we rally. Look at the recovery phase. The recovery phase wasn't market makers gapping up. We only went up $6 during the recovery phase. The recovery phase are these three right here, up 33, down 13, and up 38. So that's up $58, roughly, maybe 59, if my math is correct quickly. So we went up $59 during this recovery period. Only 6 of it was in the gap. And look at what the amateurs are doing. They're still selling. They don't get it. From 10 a.m., buying kicks in through the end of the day. We went up $55. 55 of the 59 was actual buying. No gaps, buying. Accumulation. And that's what the accumulation indicator tells me over at stock charts. It's putting all this together. So now here in this last gasp, and there are questions John, I know John was asking, I'm sure many of you are asking, okay, well, what about Friday? Friday was horrible. Is that the start of something bad? Well, first of all, this all started with options expiring. And I talked to our members about it before we started coming back down. They can attest to it. I'm not just saying it now. I said it back on the Monday that options expiration week started. I might have even talked about the Friday before. And we sent out spreadsheet. Aaron sent out the spreadsheet that weekend, a week before, saying all these stocks are subject to big losses going into option expiration week. I had moved primarily to cash, shorted a little bit, but I was not trading on the long side that week. There was too much risk. Now, as we went down, and as we've gone down this last move, we've dropped $25. Almost half of it's been the opening gap. Another $13, or the balance of it, has been the morning trading. The balance of the day, while we've lost $25 over the last 10 days, I want you to look at how much true distribution has been taking place in the last 5 hours of the trading day. 85 cents. Now, if you think all this is meaningless, that's fine. I'm just pointing it out. I love doing this research, and I think it's really important. But I'm going to now go back over the charts, and I want to show you how this looks on a chart. So let's go pull up the manipulation. We're already an hour and a half. I knew I was going to be able to do an hour. Hopefully you're enjoying this. I see not too many people have left, so I guess that's a good sign. We're about to move on to the last segment here in just 1 minute. So as you look at this chart, All I've done is I've broken down. That's the I's, the initial Wall Street reaction or rotation. There's the M's. That was the January to May distribution. This is the manipulation period where we went up, went right back down to new lows. Look at these gaps. You see the difference? This is selling. If you want money to, or you want stocks to be sold, if you're a portfolio manager and you want to get out of 1 million shares, you can't do it at the opening bell. When we drop like this, portfolio managers can't get out. The only way you can get out is to have selling during the day. There's not enough liquidity at the opening bell or in pre-market action. You've got to see selling. You know, portfolio managers will get in touch with their market makers and tell a market maker, I want to sell 1 million shares. Market maker has to put sell orders in. You have to sell. It doesn't just magically go out, poof. You got to sell. It's got to show up in these big red candles. That was the distribution phase. By the end of this, there's nobody selling. It was all manipulation. You have retail traders in the amateur hour that were selling. Gaps were 24, amateur hour or half hour, another 8. The next hour after that, another 4. End of the day, last 5 hours, we're going up $24. Who's buying? That's everybody else. Retail folks are bearish. They're selling. Market makers are buying for their clients. That's why it's so important to follow this stuff. And now during the recovery, this isn't manipulation. Very little of this is gaps in amateur hour. This is pure buying. And now we're moving back down. Yeah, that's an ugly candle. And you know what? That's pretty scary. I'm going to admit it. That's the first big red candle. I mean, I'd say this one over here back at the end of June was a similar. I'd say this one was worse though. This looks a lot like these other candles. And you know what? If we keep having them and the latter part of the day, we see lots of distribution, then we're probably heading back down to test the bottom and maybe even go to a new low. There is a possibility that's going to happen. Based on everything I'm showing you here, I don't think that's happening. So let's talk. Last thing here is let's talk about looking ahead. The balance of 2022. Why am I bullish? So I'm going to start this off with one chart that members know very, very well. This is a 100-year chart on the S&P 500. I am a big believer that we go through grand super cycles in the stock market. Secular bear market, 30s, 40s. Secular bear market, 70s, late 60s, 70s, early 80s. Secular bear market, the 2000s into the early 2010s. Those periods, we don't set new highs. We're going sideways. Equities are simply out of favor for a long period of time. Do we have periods when we do well? Yes. But we also have periods when we get these secular bear markets. Remember, I showed you 2007 to 2009, 2000 to 2002, 1973 to 74. And if I'd gone back before 1950, I could have pointed out some of these. Those are secular bear markets. I believe this was a secular bull market, 1950s and 60s, 1980s and 90s, secular bull market. And I believe when we took out the top in 2013, we took out that 2000, 2007 high. And finally, for the first time in 13 years, made a meaningful breakout. I think that started a 20-year grand super cycle to the upside. And I know people are saying, well, what about inflation? What about interest rates? What about this? What about that? Well, you know what? We had all those things. You know, we got a war going on over in the Ukraine. You go back to 1991. Guess what? We had rising interest rates. We had an inflation scare. We had crude oil prices surging much more in 1990 than they did here this year. The war, we had the Persian Gulf War in 1990. You can have, and we had a recession, by the way, and that's what everybody's fearing now. I think we're in the midst of a recession, personally. And if the Fed keeps raising rates, it's not going to help. I can tell you that much. I think the Fed's making a big mistake, but it wouldn't be the first time. I'm not a big fan of this Fed, by the way. Anyway, you can have cyclical bear markets like 1990, like 1998. You can even have a short-term cyclical bear market crash like 1987. We just did it in 2020. People thought I was crazy when I said we're in a cyclical bear or secular bull market, and that was a cyclical bear and that we were going to go back to all-time highs. I can show you articles. Go back and read my articles in 2020. I remained very bullish even through all this selling from a long-term perspective. So this can happen in a secular bull market. What we're seeing this year, I showed you all those cyclical bear markets in the 1950s and 1960s. There were 4 of them. I think we had 3 or 4 recessions. I don't remember how many we had. We had higher interest rates going throughout the 1960s. Look what the stock market did. So when you want to argue with me or debate me because the Fed is hawkish, interest rates, by the way, right now, the 10-year Treasury yield's a little over 3%. By historical standards, I'll show you a chart in a minute. That's incredibly low. I mean, there have been a lot of times in history where the stock market has soared, where we've had interest rates much higher than 3%. So I'm not worried at all about interest rates, even if they do go up. It could impact, as I've said before, the relationship between growth and value stocks. Higher interest rates, we might see value performing better than we might expect, growth less than we might expect. But that is not going to alter, in my opinion, the secular bull market that we're in right now. The secular bull market that we're in right now has averaged 13.65%. I don't remember when I updated that last, so the number might be a little different. But that's basically just taking annual average increases that we've had here. 1980s and 1990s were 15.41. 50s and 60s were 11.28. So we're right about in the middle. And I've said in 10 years, the S&P 500 is going to be more than triple where it is right now. And people look at me like, you are absolutely nuts. Well, you know what? If we do keep this in play for 20 years and we have an annual average return of 13.65%, we'll be more than triple. That's just the normal where we are now. Multiply this 4,057 by 13.65%, get a result. Multiply that times 13.65%, get a result, and do that throughout the entire period of the next 10 years and see what kind of number you come up with. It's going to be a big number. Anyway, trying to think. Okay, so if this is a secular bear market, I want you to notice on this chart a couple things. When we've had secular bear markets, look at the monthly PPO. It goes deep negative, deep negative. When we have these crashes, these little mini crashes, or these cyclical bear markets, the PPO, the monthly PPO pulls back, but we don't go into negative territory. 50s and 60s, we went right down to the center line. Maybe we went just slightly into negative territory. Then we turned right back up again because cyclical bear markets don't last long. They don't last long enough for the monthly PPO to go negative. Whereas these, we go sideways for a long time. And so after going sideways for a while and then having a bear market, you can see big drops. So you go sideways, have a bear market, big drop. Here you have a big drop, negative. And then here you come back down again. See the difference? Look at where we are. So technically, the big picture is still pointing to this being a cyclical bear market. I just don't see anything based on this chart. What are we going to all of a sudden start another secular bear market, 6 or 10, 8 years, 9 years, whatever, after we just had the last one? That's not the way history has worked. I think we're in a period of a challenge, but I don't think we're in a period of long-term falling prices. Next up, everybody's talking about inflation and what a huge threat this is. I want to show you a couple of charts. Number one, here's the US dollar. US dollar is breaking out to an 11-year high right now. Now, I don't know what you were taught in economics. But when I was in college back in the late 70s, early 80s, I had I had a couple of economics courses. I loved the economics courses. But I remember, and things have changed, by the way, we're much more global now than we were then. But I remember talking about inflation being too much demand, too little supply. And that a lot of that was caused by the pandemic. When you shut down factories for a month, and then all of a sudden you open things back up and everybody wants to get out of the house because they're absolutely losing their mind and they want to go out and they want to spend money and they want to do all these things. The government's giving them money. I mean, we had checks coming out to folks. They weren't doing anything, but they're getting money. When things opened up, they wanted to go out and spend. So you had this artificial demand and you had real supply constraint that we're still trying to get through. So when people try to tell me this is systemic inflation, I'm like, are you crazy? We had no systemic inflation going into the pandemic. And when I look at other markets, intermarket relationships, what in the heck why would the dollar be going up when we're getting this spiking inflation? I want you to look at what happened. Now we can't, the US dollar index on stock charts, I only show it at the beginning of 73. So we can't really see everything that transpired during the late 60s, early 70s. But what I can see is that when we had this spike right here, we saw the dollar weaken. When we had the huge drop in inflation in the early 80s, the dollar went crazy to the upside. This is what I learned in economics, that, I mean, the dollar can be influenced by a lot of things, but inflation's bad for the dollar. It's bad for any currency. And when inflation's coming down, that helps to strengthen currency. So look at what the dollar's doing. So here we got this inflation. And before, when we've had inflation, we've had the dollar weaken. I mean, even here, you can kind of see it a little bit. Here, we're getting inflation, right? We got this massive inflation problem. Wall Street seems to be ignoring it, along with everybody else around the world, because they're pouring into the dollar. 11-year high. So if you believe inflation's a really big problem and is only going to get worse, I've got a question to ask you. Why is our dollar strengthening? That's point number one. Point number two, let's look at gold. Here were the 1970s. Here was the inflation. Look at the inflation. Here's the price of gold. Here's the price of gold relative to the S&P 500. This is, again, what I learned back about inflation. When you've got inflation, gold is a great hedge. And so Wall Street is going to move a lot of money into gold when you're expecting inflation to be a problem. It did it here. You can see gold went up. On a relative basis, it went up when inflation went up. Inflation started to come back down. What happened to gold? Came down. Inflation took off again in the late 70s. What happened to gold and to the relative performance of gold? It soared. The reason is we had a real inflation problem back then. Real inflation problem. It was killing us. Now let's fast forward all the way to this major, I'm saying this with a little sarcasm, major inflation problem we have going on right now. There's your inflation. This is a 12-month moving average of the core CPI, by the way. So right now it's at 5.91%. We got up to 13%. Actually, we got up higher than that, but this was a, well, I guess maybe at the end of the month, that was the highest we got, roughly to 13%. Anyway, we've gotten to 6%, a little over 6%. It's starting to roll over a little bit, but this is how scared Wall Street is. Gold, which during this period has moved up, there's no doubt it's moved up. I give it that. What's it done on a relative basis to the S&P 500? I mean, we saw what happened back here in the 70s. I mean, it was get the heck out of stocks and jump into gold. Are you seeing that same thing here? I'm not even seeing I'm not seeing the relative strength of gold even budge to the upside. Why isn't Wall Street pouring everything they own into gold? I mean, inflation's a really big problem right now, right? inflation is not a big problem. Yes, it's out there. And yes, the Fed is talking tough. And you know what? The Fed said we were going to get rate hikes during the trade war back in 2018. And I said, no, we wouldn't. And they cut rates next in July of the next year. They love to talk tough. And Jay Powell has a pretty good history of spooking the stock market. Go back and look at his speeches back in the fourth quarter of 2018 and what happened to the market. We had a cyclical bear market, which I think was triggered as much by the Fed as it was by the trade war. And now you look at what happened on Friday, and yeah, maybe I'm biased. I think it was triggered by an inept Fed. I mean, I think it's okay to say that, hey, we're watching inflation. We got your back. If inflation's a problem, we're going to raise. One thing that lifted the market recently is they moved to being more data dependent, which, hey, that's fine. The market liked that. But now the Fed comes out on Friday, and I quote, expect more pain ahead, a lot more pain. Or I don't remember, I was quoting, but I probably shouldn't. I'm paraphrasing. Whatever Jay Powell said, he doesn't need to do that. I mean, he doesn't. I don't know. I felt like this was a little bit orchestrated. I don't know why. But let's just see how this plays out over the next couple of weeks. Watch that intraday. I'll promise you, I'm going to be watching it. If you're a member at EarningsBeats, again, we have a 60-day free trial. This is going to be a pretty good 60 days to take a free trial out. The only thing I ask is that if I save you for the next 60 days, please commit back to us after the 60 days are over. But you try us, and I think you're going to love what we do. Anyway, this is gold. Where's the inflation? Wall Street doesn't seem to think there is any. And so once again, I'm not saying it because I've got some inside scoop about the economic reports that are going to come out. I'm just simply looking at the charts. I follow not what the analysts are saying on CNBC. You might as well just mute it. Look at the headlines or whatever and mute. Because the only time I've ever heard Wall Street lie is when they open their mouth. And I may be saying some harsh things to some of you. You might be thinking, wow, they lie. Let me tell you something. These Wall Street firms like Goldman Sachs, they manage people's money. They manage really rich people's money for the most part. Okay. They know what they're doing with those folks' money. And the only way we know is by following the charts. But what they're doing there could be completely different than what they're doing when they send their analysts on to CNBC, which, by the way, the Goldman Sachs of the world pay a ton of advertising revenue to CNBC. So CNBC knows who's buttering their bread. It ain't you and me. They don't give a crap, pardon the French, but they don't care about us. They don't care about showing you what I'm showing you today. They care about taking care of their financial partners. And that's why I haven't watched CNBC in 3 years. I swear to you, I have not watched the show, any of CNBC, in 3 years. I will say occasionally I've had the channel on and I'm looking at some of the headlines, and I go to CNBC.com and I do happen to see headline news and so forth, which I just kind of chuckle at, but I do not listen because I don't trust anyone that's going on there. I think there are a couple people that I would listen to on CNBC if I knew they were coming on. And a lot of times I'll go to YouTube and watch just their clips. Warren Buffett is one. I really have a lot of respect for Warren Buffett. And from a technical perspective, I really like Carter Worth. Those are the two people, because I want somebody who's going to talk to me technically about what they're seeing in the market, not their biases. Most technicians have personal biases that either are way too bearish or way too bullish. And I know many people probably thought that I was one of those way too bullish analysts. I'm not. It's just that I showed you the historical facts. The market goes up a lot more than it goes down. I am only going to be bullish when I think it pays to be bullish, which is basically anytime I'm not bearish. I default to bullish. But I think after showing you what I showed you today, the articles I was writing, I didn't go through and show you all the daily market reports. I write one every day to our members. I only publish over at Stock Charts maybe once a week, twice a week tops. I write to our members every single day. And I can promise you that I have been with a very bearish slant almost the entire year. Well, at least through the middle part of May. And I started doing some videos and some shows, and in on the videos and maybe even some of the articles I was writing at Stock Charts, I was saying that a bottom is getting closer. A bottom is getting closer. And that's because some of the sentiment numbers I wanted to see were starting to move. Some of the rotation was starting to change a little bit, but it wasn't until June, mid-June, that I said, this is it. And it was because everything came together all at the same time. Now, again, looking back at this gold chart, I know I got off topic there for a second. I do that a lot. Sorry. But you can see, I'm not, this isn't disputable. This is fact. Explain to me why the dollar broke out with inflation problems. Explain to me why gold is not going higher relative to the S&P 500 if inflation's a problem. Enlighten me. Maybe there's something in economics I don't understand anymore. I'm being serious. I want to know why Wall Street isn't moving into gold and why they're not selling the dollar. Inflation, again, I like to combine fundamentals, technicals, historical. I put it all together. And you can disagree with me. That's fine. I'm not going to be right all the time. That's the only guarantee I ever make, by the way, is that I will be wrong from time to time. I will not be right all the time. That is a guarantee. But I think one thing that I'm really good at doing is managing risk, knowing when it's time to really think about being risky and when it's time to kind of pull in the reins a little bit. And I know when it's time to be in cash. And I know when it's time to maybe think about shorting. I'm not a big shorting person. Why would I be when the stock market's gone up 54 the last 72 years? If you want to short every year, every day, every week, whatever, go ahead. But you're going against the historical tide unless the market gives us those signals like it did in 2022. Interest rates. Wow. We should really be fearing interest rates, right? I mean, wow, we're up over 3%. Being a little sarcastic. Back in the late 70s, early 80s, when we went up to 15, 16% on the 10-year Treasury yield. Since then, for 40 years, we've been downtrending. Now, I believe the potential here is that we have just broken the downtrend. Although I will say this, if I annotate this for just a second, I'll be honest, I thought the same thing happened here. You see that move down with all these trend line tests, and you see this move up, clearing this test. I thought back in 2018 that we were breaking out. I couldn't have been more wrong. So yeah, this looks like now we're getting a little bit of a breakdown if we connect that high. We still got this overhead resistance on a monthly basis that we need to clear about 320. We haven't done that yet. I mean, let's at least get through there. And the other thing I would just say is that I'm not going to be worried about the market until we get maybe interest rates above 5%. I mean, I just don't think 5% is expensive when you talk about borrowing money. It is, if you look back over the last 10 to 12 years, but through our history, 4 or 5% has been a pretty good rate. I mean, this is dating back to the 60s when rates were at this level. I mean, this has just been crazy. Anyway. Two more charts. This is one I'm watching closely. The University of Michigan Consumer Sentiment comes out twice a month. First time it'll be the actual, and then they update it. They give you a second reading later in the month. But consumer sentiment's pretty good predictor of recessions. And you can see that the consumer sentiment peaked in 2007, and it absolutely was collapsing before we actually had the Great Recession. 2011, I know the market went down. I mean, I don't think we hit recessionary period there, but you can see the big drop. My point is, once the sentiment bottoms and starts coming back up, that's when we tend to have very, very strong rallies in the stock market. Here's your bottom recovery. Here's your bottom recovery. There was your big move down, recession. I think we've had the big move down here. That was a big move down, clearly a recessionary period with the pandemic. And then look at this. Throughout 2021, this was another thing that I had talked about at the end of 2021 and throughout early 2022, is look at sentiment, which is just falling through the floor, it's crashing. It went lower than it went back in 2008. Everybody was so scared. And now it's rebounding. And I just think once you get down to this level, I mean, once we got down to this level, we went down close to it, but basically you bottom. And when you bottom, the stock market bottoms. Look at where the bottom was. June. That sounds familiar. So the last chart I'm going to give you is my projected path. This is what I think is going to happen. I think there was some damage done on Friday. I mean, I'm not going to sugarcoat it. There was distribution even on Friday. I mean, we saw that late day. I mean, it didn't recover. We saw no buying at the end of the day. So I believe we are going to go down, but I'm going to start watching every day for these reversals in afternoon action, because I think we're going to take one of two paths here. Remember what I told you about July 17th to, I mean, if we go back and look, let me see if I can find. If we go all the way back to the historical data, if you came in late, it's one of the first things I talked about. But if you look at the weakest time of the year, it's July 18th to September 27th. Historically. And we've had some big drops during that period, but we've only gone down 31 the last 71 years. So as I look at the market and I look at the possible areas, could September be a bad month? Yeah, I mean, historically, we've seen it before. I think we have to respect that candle from Friday. I can tell you back in the fourth quarter of 2018 during the trade war and the last Jay Powell debacle, when he said we were going to get multiple rate hikes and we never got any, and we had a rate cut 6 months later. I mean, him coming on board and saying that now could be similar to then. I mean, it was in December. By the time another week or two rolled around or rolled past, we bottomed and started shooting right back up. I think it's possible, and I didn't even really put this as a third scenario, but it's possible we could go down early next week or something and then just shoot right back up. But I got to see that first. Friday's candle, short term, is making me much more cautious. That's where I stand on that. When you lose your moving averages, I mean, on a daily chart, we had moved above the 20-day. I thought with the Fed speech, I thought we had an opportunity. And what I thought the Fed was going to say is basically what they said at their last meeting, that, hey, we're data dependent. We're seeing some signs of inflation moderating a bit, but we're going to remain vigilant. That I get. I have no problems. But when he comes out and says, we got problems, we got pain ahead, and then, of course, that was the headlines all over CNBC and everywhere. Now they've got reason for folks to sell off for a period of time. And so how much do we sell off? I don't know. I think the two likely paths for me are when we bounced off of June, we had this initial rally, consolidated a bit, and then we broke out. That was 3,900. I think the 50-day moving average is somewhere just below 4,000. So I think 3,900 up to the 50-day moving average, that could be a potential bottom. Or the second scenario is that we struggle for a period longer and that we do over the next couple of months go down and put in a double bottom or close to it, which would really scare the heck out of everyone. And I'll be watching that for the manipulation aspect of it to see, are we really seeing distribution? If we're going to go back to new lows, we need to see a lot of what we saw on Friday. Not one day of it, We need to see a few weeks of it, and we need to break down. We need to see what we saw in January. And so that means where, let me show you that manipulation chart. So massive distribution, where we were seeing selling in the latter part of the day. We were seeing gap downs, but we were also seeing a lot of selling throughout the day. That's what we need to see for me to believe that we are going to break down below that 36 low. I called that bottom in June, the day that it happened for our members, the day before on YouTube. And I think that weekend for stock charts, folks, it was all right around that same time. And I will still to this day will defend it. I don't care if we go back down. I don't care if we go down 5% next week. I still believe that bottom is in. Now, again, when will I say that it's not, or that there's a good chance that it's not going to be? If we go down not via gaps, which I think is a lot of manipulation, but actual selling. You see a bunch of these red candles, I'm going to get really nervous. That's how my attitude is going to change. Otherwise, if we see what we've been seeing, which if we wake up Monday and we gap down to 295, another big 4% or whatever at the open, and then we come back up and close at 300, that's not going to be very scary to me. I'd be more scared if it opened at 307 and sold off to 295. And we saw a massive distribution taking place on Monday, just like we saw today. That's what would scare me, because when we saw the distribution start back here, it didn't end. We look at all these big red candles. Then we moved up. Some of these moves up were gaps. And we had a couple gap downs, but we still had many, many big red candles all the way through. Here's one right toward the end. And then all the big red candles seemed to vanish, except for a couple of these in the middle, but most of that was gaps. Anyway, so that's what I'm going to be looking for in terms of the projection I just talked about. So I think we could go down to 3,900 to 3,975, 4,000 psychological support. So let's say the milder version of a pullback is maybe only another 1, 2, maybe 3% to the downside. The more difficult environment would be if we get the double bottom, and that could be another 10% to the downside. And again, I would be having a different conversation with you right now if it weren't for Friday. I had to kind of change some of my charts after that day yesterday. But in any event, I also want to remind you of another thing that I pointed out earlier, and that was back on that historical chart. This period right here, October 28th to January 18th, it has ended higher than it began 62 of the last 71 years, including 36 of the last 39. Seems to be a pretty bullish historical bias, I think. And so that's why you see if we do go down, I'm drawing that line to the end of October. That's maybe the worst case scenario is what, based on what I'm thinking. And then we absolutely start screaming higher in the fourth quarter. Here, I think the chance of us getting to a new all-time high is probably pretty diminished based on Friday's movement. I was on the verge. I saw the poll that went out to everybody, and we can wrap this up now, John. And I ended up going 2 hours, but I think this stuff is so important. In the poll, I probably would have answered the poll that I think we're going to go to an all-time high if we did not have the Friday action we just had. That was pretty damaging technically, and it could give us much more reason for pause on rallies. You're going to see more sellers at different areas, moving averages and so forth. It's going to be a little bit more difficult to keep the market going. We were above the 20-day moving average. We were above the 20-week moving average before Friday. We're beneath both of them now. So we've just got more obstacles to overcome. So what I'm going to say is that we trend higher into year end. I'm not giving you the most bullish of those choices, but I think we rally into year end. But I don't think it's all the way back to an all-time high. I think that comes in the first quarter, probably in January of 2023. That's what I would be looking for. So that's what I had for today, John.
Wow. That was awesome.
Thank you.
Excuse me.
Speaking of biases, I know
A lot
you're
of great
biased.
feedback from people. Somebody wanted to mention that that June 17 bottom that you talked about,
Mhm.
that you actually sent an email out to members. So a lot of people asking about the service and what we provide, and I pretty much answered their questions. But I think it's important to understand that, because I've been working with Tom for many, many years, that you're going to get daily information from Tom real time. So you could hear something, from an analyst, or you could have a day like Friday, whatever. You're going to get real time feedback from Tom. So if something changes, you're going to have that information at your fingertips right away. Also, a lot of people asking about a couple of the articles you referred to, and we'll make sure that they're included, when she sends the recording out, how to get access to those articles. The other thing too is that the recording will be time-stamped. So if you want to move around at your leisure, no problem with that. But I would say, Tom, for sure, the most questions that came in, because we don't have a lot of time here, but I wanted to get to this, really did have to do with, Friday's action. You kind of covered that pretty clearly, how you're seeing it. An observation that I made was from that June 17th bottom to the most recent top, just over 4,300, was about an 18% climb in a quick period of time. Since then, the top to Friday's close, we gave up, about 8%. So not quite half of the 18% climb, but close to a 50% retracement, which seems kind of reasonable, right?
Yeah, I mean, like I said, the third alternative, and I didn't put it on the chart, was that we just turn right back around and go up. I mean, it wouldn't shock me at all, just based on what I've seen when I went through all this manipulation. And just to follow up on one of your other points that you made earlier about the June 17th daily market report that I sent out to members. The one thing that you'll get from me is conviction for the most part. I'm not going to say, hey, the market's going up today, the market's going down today. There are some things I'm watching. I'm going to waffle a little bit, but as far as it goes with the major calls, I think I've been pretty convicted in terms of us being in a long-term secular bull market and calling a short-term cyclical bear market ahead of time and following this whole thing through with our members. And we've done a lot of these sessions. We've done a lot of free sessions because I do like to get back, give back to a lot of people out there who are only hearing from CNBC and some others. And I'll be honest, there are a lot of technicians that drive me crazy. I can't figure out if they're bullish or bearish because they won't stick their neck out on line. It's like, okay, well, we're bullish now. It looks like the bottom was in 2 months ago because we're trading above this moving average. And then it goes back down below the moving average. And they're like, oh, now we're back into the bear market. You can't trade like that. I don't know how you can have any conviction to make trades when you literally day to day or week to week are changing your opinions as to what the long-term direction of the market is. So anyway, just wanted to kind of mention that. Any other questions?
Yeah, it's actually a few people asking about the special, where they can find information about the trial and the annual special. So I don't know if you have a page available for
I
that.
think I can pull it up.
I believe it's also going to be on the site, correct?
Yeah, it's on the site. So if you go over to earningsbeats.com, right here at the top, there's this webinar special. If you click on that, it'll bring you right to this page. And while you're at EarningsBeats, actually, I think everybody that's in here has been added to the EB Digest. If you were not already on our EB Digest, that's a free newsletter. Again, 3 articles a week, Monday, Wednesday, and Friday. It's a give back. It's a way for you to get to know us. I think this 60-day trial is ridiculous. I mean, I hesitated because you can see what we're doing in 30 days. You don't really need 60 days. It's the first time we've ever done a 60-day free trial. And I can promise you this is going to be coming down very soon. So if you want to take advantage of a 60-day free trial, look at our service. We're going to give you until Monday to follow through with the annual. If you really want to get our service and be part of this for the next 14 months, actually, I guess it will be 16 months because they get a 60-day free trial. And if they sign up, the annual plus their 2 bonus months will be added to that, right?
Yeah.
I'm asking for a friend. So I think they get, unless.
That would only be if they upgrade before Monday. So if they
Okay.
purchase trial and then purchase annual, we would honor the 16-month.
Hey,
But that would
Aaron,
have to all happen before Monday.
Aaron,
Yes.
while you're here too, somebody was asking about how the special works for existing annual members. I believe if they sign up for extend the annual membership now, would they get those 2 bonus months?
Yes, they would.
There you go. So if you're an existing annual member, you're not going to be able to beat this. You're going to be able to sign up for the annual plus get the 2 bonus months, and all of that will be added to the existing time you have. So it's a tremendous deal.
And we are going to reserve the 60-day offer in that scenario for anyone who's brand new to us. Just because we really want those people to have the opportunity to get to know us. So if you are brand new to us, sign up for your trial. And if you like what you see over the next couple of days, you can extend under this annual offer.
Awesome. Appreciate that. Thank you, Aaron, John, for clarifying. I wasn't 100% sure how it was working, but I can tell you that the annual membership with 2 bonus months, we've never had a better offer than that. So if you're thinking, well, I'll wait and get a better, that's the best deal for extending 1 year. 2 bonus months, the best we've ever done. So you're actually getting more because if you sign up by Monday, you get that 60-day free trial instead of your normal 30. So you're actually getting 4 bonus months in addition to the annual. So you're getting 16 months for the price of 12. I don't know if I can do much better, that we can do much better for you than that.
You know,
So
Tom,
be sure to check it out.
yeah,
Yeah.
here's a question that I think is very timely, because people, I think, trying to get a sense of how you communicate to members. And the specific question is, what did Tom send out during the day on Friday, 8/26? My recollection and reading of what you sent out to everybody yesterday was, if the selling picked up, that we could potentially see a visit down to 4,000. Is that right?
Yeah, I'm actually going to pull it up.
Yeah.
I write so much, John, and trying to get ready for this thing to try to remember exactly what I wrote. But I'll pull it up because I do have it here in my.
I'm pretty sure that instead of salary things picked up, we could be looking at, 4,000, which is, by the way, just a bad morning away. It's not like, torturous. It's maybe 60 points, which, by the way, corresponds right to the, I believe, the 50-day, which is just beneath that.
Yeah. I when I wrote, first of all, it was kind of a special report. Normally what I do, and this will answer a lot of member questions too, because I think some members wonder why I always send out the daily market report late in the day. But part of what I've been explaining as far as manipulation goes in the market, that a lot of times you can't rely on what you're seeing in the morning. So if I wrote something at 10 or 11 o'clock in the morning and I sent it out to our members, everything could change by the time 3 o'clock came around. So I like to do the daily market report later in the day, most of the time. Now, sometimes my schedule doesn't permit it. I'm just not available. But if I'm available, I usually try to send it out later. And it didn't used to be like that, but I feel like there's so much manipulation that I really want to send it out like around 3:30 in the afternoon, which is about a half hour before the market closes, just so I can see more of what's taking place during the day and get a better feel for the market. But the one on Friday, I didn't wait till the end of the day. I actually sent it out in the morning. And part of it was because of what was transpiring. I mean, the Fed chief, Powell, he started talking at 10 a.m. And I don't know if you watched, but a massive amount of selling took place between 10 and 11:15, 11:30. And then it kind of went steady for a while. And then we saw some more selling into the close. But the overwhelming majority of selling was by 11 o'clock in the morning, 11:15. And so that's why I wanted to get it out in the morning and talk about what was going on. So I painted a couple scenarios at that time. And basically I was like, okay, we've seen a lot of morning selling and big afternoon recoveries. And I said, if we have an afternoon recovery, then basically look out above, because this is the bear's chance essentially to really get control of what's going on. But I did say, and this is a quote, things could always change into the close, and I wouldn't put anything past the market makers. But right now, I feel the odds of a 4,000 test on the S&P 500 have grown immensely given today's action, especially if the selling doesn't cease. And I said a reversal today would be incredibly bullish, however, because there are few traders that are going to be willing to jump in front of this freight train. Wall Street will need to put their collective resources into action to reverse this selling. And if that happens, then we'll likely be witnessing a major price support in the current uptrend. So that was essentially the message I gave. If we didn't rally by the end of the day, I'm turning more bearish short term. If we did rally and it was another one of those manipulative days, then I could see a gap up and just a quick move back right back up next week. But we didn't get that. And that's why I'm tempering my bullish enthusiasm now, probably for the next 1 to 5 weeks. Maybe could even stretch into October based on the historical work that I've done. But I think if we're really going to sell off, I think between now and the end of September is when it's going to happen. So bears, here's your chance. I've been bullish. I've kind of been egging the bears on a little bit, but hey, I recognize when we get some, some chart difficulties or some breakdowns, and I recognize them, I admit them, and I would be very careful right now until we can get back up through the 20-day EMA. If we get back through the 20-day EMA, I will turn more bullish again until we come back down below the 20-day EMA, because these move to the upside when we get above the 20-day, coming out of a cyclical bear market bottom. I showed you that analysis. This is when you get the biggest moves back to the upside. So if we break back up above that 20-day, I'm not going to be really looking for a whole lot of other signs, especially if the manipulation that I pointed out continues here over the next several days. So that's kind of where I stand. I know it's a little bit wishy-washy, but I need to see what the market does and what the manipulation looks like and what the sectors are doing, my sustainability ratios, all of those things are going to factor in. And that's how I'll be making my decision.
I got a question from somebody who wanted to see the email, to members. I don't know if we can get the actual email up, and I'm looking at the June 16th DMR that went out. And whoever asked that question, if you want to send an email to support@earningsbeats.com, they can get you a copy. But I'm telling you, at the very end of the email on June 16th, this is exactly what you said. I'm calling the bottom right here, and that was in caps, by the way. And right now, I'm fully invested. Am I right? I'm comfortable letting future actions prove me right or wrong. So I just wanted to read that specific language from the June 16th DMR.
Yeah, I've actually got it actually on my other computer. I usually post it right here. There's Thursdays. But I know yesterday when I posted, I was in a hurry to get it out to our members. And then also I was trying to work on this presentation for today. So I may have just slipped my mind. I may not have posted it. That happens rarely, but we can get you a copy of it for sure. And in fact, I'll go back because I got the latest. I'll just post it when I get done with this. I'll go post it right away. And so if you're a 60-day trial member or whatever, and you want to come in and see the exact report, you can do that.
Somebody asked a question. I do want to address this. Does the membership include buy and sell alerts? I want to say that we used to have, very specific buy and sell alerts with entry levels, exit, et cetera. And it just became too daunting to track everything. But I want to tell you that every single day that Tom does his daily market report, there are generally very specific ideas relating to specific stocks that members can do what they want with. We've also got our now 3 portfolios that have very specific stocks. We just had a recent session. We do this every quarter where we lay out specific stocks that people can consider depending upon their style. But there's so much macro information that Tom provides in addition to that, very specific stocks that he thinks are worth looking at. And I don't know if we want to add anything to that.
Yeah, I pulled up the daily market report on Wednesday, and that was a kind of a brief report as well. I've done a number of these over the last few months just because things change so rapidly in the market that when I do a full length DMR, a daily market report, it takes me up to a couple hours, sometimes even longer than that, to put it together. And by then the whole market can change. I mean, so sometimes I'll do things pretty quick. One thing I pointed out, for instance, in Wednesday's webinar was that the semiconductor chart was down at a major support level and printing a positive divergence. And I went on to say that I liked NVIDIA, and then I had to come back with a later report, just mentioned to everybody that NVIDIA was reporting earnings. But you can kind of see where the support was on NVIDIA, right around 168 or so. And I'll show you both these charts in just a second. But one thing I said was I expected the next rally could be led by semiconductors, which it was for a couple of days until, of course, Friday happened, which I didn't see that one coming. Maybe I should have with the Fed speaking, but I didn't think we'd see that kind of a negative reaction because he honestly didn't say anything different. He just went on, record as saying, hey, now we're going to have more pain ahead or something. I don't even know what he said. It was pretty irritating for me because I just want the Fed to state the facts. I don't want the Fed to editorialize, more pain ahead for who? I mean, to me, if inflation's a problem, you want to raise rates. You want to squash out inflation. Yeah, that might be a little painful in the short term, but long term, it's much better for the stock market. So I don't know. The whole thing, I think, was just blown way out of proportion. And just, again, one of the little things that it's like nails on a chalkboard with me and Jay Powell. I just don't like the way he communicates. And sometimes he's just flat out wrong. And of course, never comes back to admit it. They just changed their policy. But anyway, let me show you the chart on semiconductors. Of course, there you can see the big reversal. But on that hourly chart, I mean, you can see that's where I sent out the DMR showing I really expected semis to take off, and they did. That's a 300-point rally in less than 2 full days until, of course, everything got whipsawed yesterday and got crushed. NVIDIA, which reported its earnings, look at the gap down. Where did it gap down to? Remember, I was showing the support at 168. There was your gap down with earnings. That thing was up $11 in 1 day from the open. And I think on the show that I did that morning, which was Thursday morning, probably go back and listen to it, I indicated that it was down, but I expected that we would see a big rally, a big hollow candlestick off of that initial open. And that's exactly what we got. But again, thanks to Jay Powell. And some of you might completely disagree with me and think we're going to new lows, and that's fine. You might be right. Maybe we are. But I laid out my case, and, everybody can think for themselves and decide, what they think about where we're going. But I think, again, it's about managing risk. Do you think it's riskier to be in cash and have the market take off without you? Or do you think it's riskier to be in the stock market and experience something that we've experienced 3 times in 72 years, which is a secular bear market? I mean, I know which side of the coin I'm on, but I've got to see short term get back up above that 20-day moving average. And then I'll start to grow more bullish again.
The primary reason we had this session today was because, we did an analysis and look back at our service and really going back to the pandemic, which was another, great call by Tom. And then a couple of our market vision events, which are held once a year leading into the next year. then also some of the calls he made, well, particularly Market Vision 2022, when Tom alerted our members that there was a lot of trouble ahead and a time to really be super cautious, and then getting to the bottom June 17th, sort of packaging all this together and listening. I listened to, unlike Tom, I listen to CNBC because I just want to hear what other analysts are saying and, get a sense of how they are stacking up against our service. And just the incredible number of people who got so many things wrong. Listen, this happened the other day. I shared this with Tom. I'm not doing any bashing here. That's not my style. But I literally was out on the porch the other day after, it was earlier this week, when I was listening to Jim Cramer, who I think, by the way, is a tremendous entertainer and a genius in his own right. So don't believe with everything he talks about. And by the way, Tom had mentioned Carter Worth before. I'm bullish on that guy. He's a great technician. As a matter of fact, Tom, I want to make my point about Cramer, but Carter Worth the other day, remember when Apple was refusing to go down and we said Apple has to start going lower for the market to go lower? Carter Worth had come out the day before and said, sell Apple. And of course, we saw what happened. But anyways, back to Cramer. Cramer came out the other day and he said, not many analysts have been courageous enough to call a bottom. Now, this is after the S&P had gone up 18%. He said, I'm here to say that I'm calling June 17 the bottom after an 18% climb. I don't see that as going out on a limb. What I see as going on a limb was when Tom on the day of said, this is the bottom. And Tom's been so right on so many calls compared to so many other analysts. We needed and need to get him in front of more people like many of you who are listening to us for the first time. You heard Tom's background. The one thing I've discovered about Tom in the 30, 40 years we've been working together, I know I've known Tom that long, is that if he sees a call that he's made change, he's going to let you know. Me listening to Tom today when he said, for the first time, a little bit of caution about Friday selling, he's going to watch that very carefully. If that turns into something more than just a big sell-off for one day, you're going to learn about it. So I really felt it was important and still feel important. And I ask everybody in here to share this information, share your, about EarningsBeats with people. Education is number one on Tom's priority list. End of story. We got no skin in the game in terms of market making, in terms of profiting from stocks going up or down. If you're looking for an unbiased individual who is going to share with you every day his thoughts of the years and years and years that he's put into this in terms of his own training, this is important to me, and I know to EarningsBeats to share with everybody. I had to get that in, that I have observed so many different analysts who have been so terribly wrong, that if you're looking for somebody that you want on your side, I think you're going to find that with Tom. I'm a big Tom Bowley fan, and I think a lot of you who start working with her are going to find the same thing. So I had to toot your horn, Tom. I had to do it.
Yeah, I want to add one thing to a question that came in earlier too about, do we issue buy and sell alerts and so forth? Because I feel pretty strongly about this. I think there are a lot of services out there that do that, provide buy and sell alerts, and yet they're not licensed to, they're not licensed as a registered investment advisor. You can't, by law, you can't give advice to folks if you're not a registered investment advisor. I am not a registered investment advisor. John's not a registered investment advisor. No one at EarningsBeats is a registered investment advisor. The company itself is not a registered investment advisor. We're not licensed to give out buy-sell decisions or input. And for all the services out there that do that, I would just say I think they've crossed the line in terms of providing advice. If they're not registered investment advisors, I don't think that they should lawfully be doing that. What we do at EarningsBeats, as I mentioned earlier, we started this business primarily as an education service. We've added research, we've added guidance and things like that, but everything that we provide is educational in nature. I will show you on a chart, for instance, like I just did with the NVIDIA right here, that this support level, you know, that looked like in the morning we were going to open near this level. I liked semiconductors. I really thought that we would have a big move up. But in that case, what I'm trying to do is teach what I've learned over the years. If you decide to go buy NVIDIA, that's on you. And, you know, I don't know everybody's personal situation. We got a lot of members at EarningsBeats, and we've got folks that are really conservative and, you know, want to stick to maybe Procter and Gamble and some of these other stocks that pay dividends. And then we've got others that are buying calls on the SQQQ. You know, I mean, we're getting, you know, option plays on juiced ETFs. And it's like the difference between the willingness to accept risk is so off the charts. How could I possibly have a service that's, you know, one size fits all? What I do try to say is that if I do pull up an individual chart and I look at it and I think it's a really aggressive stock, I normally will say something that, hey, this is really aggressive. If you're somebody that might not handle a 10 or 20% loss in a short period of time, you might not want to consider this trade. And so then I'm just trying to give you more information about the risk and so forth. So that's the way we approach buy, sell. I honestly, I think it's very, very irresponsible for services to be sending out text alerts, buy this stock now, sell this one now, when you haven't done the necessary research on what someone is willing to risk, what their risk tolerance is. And maybe that's just me being conservative as a CPA and actually being ethical. Wow, there's something. But that's just the way I approach the market. And so I'm really careful about the way I word things a lot of times, because I don't want someone to look at something I write and say, oh my gosh, Tom said to buy. He gave me this advice. I'm telling you right now, it's not advice. It is something I see on the chart, something I've learned in the past, the way I approach the market. And if you want to make a decision to buy it based on what I'm providing you, by all means, have at it. But I can't take that risk for you. And when I start sending out buy and sell alerts via text, I'm taking risk. And I don't even know what your risk tolerance is. And that, to me, is just completely irresponsible. So that's the reason why we don't have those things. But like John mentioned, almost every DMR, I'll talk about scanning strategies. I'll pull up charts, how you can pull things, you know, what I like about this chart, what I don't like, where you might want to consider a stop. You know, is it aggressive? Is it, you know, a little safer? Sometimes I'll put like General Mills or Procter and Gamble in there, and I'll be like, hey, if you're more conservative, this trade's probably a little bit more your style. But that's what I try to do. I have no interest at all in going back to issuing alerts, because we, like John said, we used to do that. And I think it's crossing the line. The other thing that we found is that when we would issue alerts, and, you know, you go through hot streaks, just like anything else, you're not going to be right all the time. I was doing really well with the NVIDIA and the semiconductor call. And then all of a sudden, out of nowhere, we get the Fed, you know, more pain ahead quote, and the whole market falls apart. All of a sudden, a really good trade turns into a bad one. It wouldn't matter what you bought on the long side on Friday. You probably lost your shirt because everything was getting hit. So for me, it's more about teaching the things I've learned over the years and managing risk and doing those things rather than buy Apple, sell Apple, buy Microsoft, buy this short squeeze stock. Yeah, we'll point them out from time to time, but I don't like the idea of getting back into a service where we're essentially recommending. I just think it's a very gray area, and maybe even on the other side of gray.
Hey, Tom.
Yeah.
I think we can need to wrap it up here. A couple quick things. Number one, if there's a pressing question that we didn't get to, you can write to support@earningsbeats.com, and we'll do our best to get back to you. And specifically, as it pertains to membership, if you have any questions that didn't get answered today. We're getting a lot of people signing up for the trial and the annual membership. We thank you very much. If you have any trouble, signing up for any reason, just write to support@earningsbeats.com and you'll get an answer. Aaron will be preparing the recording and sending it out as quickly as possible, along with any links to articles that Tom had. You'll be getting that hopefully sometime, today. And again, we appreciate so much the time you took. We had so many people in here today, we could never get to all questions. We tried to cover the ones that came up the most. And a lot of great sessions coming up over the next 60 days for those you sign up for the trial. I think you're going to find it to be valuable. Also, just so you know, when you sign up for a membership, I personally will reach out to you over that first month, asking if you have any questions. Is there anything we can answer for you? Customer service is very high on our priority list. Between Aaron, Matt, they'll be getting back to you quickly. And once again, I want to thank everybody for coming by today. And Tom, you might have final words.
Yeah, I mean, the one thing I'll say, I'm here on a Saturday doing a 2.5-hour webinar. It's now turned into 2.5 hours answering questions. I do this because I have a passion for helping people get by in the stock market. I'm frustrated by all the misinformation on CNBC and other media outlets. I think it's absolutely horrible. I know who butters their bread. I know who they're loyal to, and it ain't you and it ain't me. And so the reason I came back to EarningsBeats back in 2019 was really to establish a service that I think is a service that can help people better manage their retirement, better manage their trading. And I'll toot my own horn here. You're not going to find anybody more honest than I am. Again, I'm a CPA. I had to pass an ethics test. I'm not going to give you anything that isn't the truth. And am I going to be right every time? No. And if that's what you're looking for, if you're looking for perfection, I can tell you right now, we're not going to meet that bar. But if you're looking for somebody who's honest, who you feel like you can trust, and you like their opinion, you like the strategies, the way we look at the market, the way we dig deep, the way we do things different than everybody else, then I think EarningsBeats is your service. Again, 60-day free trial, a 2.5-hour free webinar. We'll be doing other webinars, both free and member, that you'll get over the next 2 months as a free member. And just check the service out. And if you think this is something that you really want, the annual deal is never going to get any better. You got till Monday to really check things out over the weekend. We'll give you all day on Monday and, see the daily market report. I'll try to do a really good one for Monday. But, I'd love to have you. We do all this. I like to be a nice guy and all, but we do all this because it's our business. And obviously we need committed folks like you all to come in and to help us in our business in order to fund people coming in. I'm actually hiring my son, who's going to join our business here in the next couple of days, because I need more people to do more research. That spreadsheet that I showed you, I did it. That QQQ spreadsheet, I took time, probably took me, I don't even know how many hours it took me it probably took me 3 hours to do the QQQ, but I also did the spider, or I didn't do the spider yet. I did the QQQ. I did the XLK, which by the way, I meant to show you and I completely forgot, but the XLK, I still have it up. I believe I can show you here. Hold on one second. Here's an interesting stat on the XLK, which is the ETF tracks technology. It's dropped $30.35 since November 19th. Do you know what the gaps are? So it's dropped $30.35. You know what the net gaps are? It's dropped $30.59 at the opening gap. So the entire sell-off in technology was basically the opening gaps. Now, do you think that's folks getting out of technology? And if you've heard this anywhere else by anybody, send me an email or just send it to our support@earningsbeats.com and tell me who it was, because I'll congratulate them. I mean, this is the type of stuff I like to dig. I like to find what makes the market tick. I like to find anything I can to help our members have better information to manage their money. And if you only improve 1% in your performance per year over the next however long you invest, I can promise you that's going to be a very significant amount of money by the time you're, retired or maybe, saved up for whatever it is that you're trying to save up for. But you're going to do much better than 1%. I think anybody got out of the market this year back in January and got back in mid-June, I think they're probably beating the market by more than 1%. They're probably up on the market by probably about 40%. So, and that's just, this year. Anyway, enough out of me. Again, just give it some thought. We'd love to have you become a member here. I can only tell you that we will commit everything we can in our resources to help you in your trading. And if you do try us for 60 days and we're not what you're looking for, I'm completely fine with that as well. We want members who really value what we do. And if, for whatever reason, it's not a fit, I completely understand. And I'll thank you for your 60-day trial. Anyhow, everybody have a great rest of your day. I'll be back on Monday. Happy trading, everybody.